Good morning, everybody. Welcome to Trade Live with IG. Hope you've had a very good weekend. I am joined this morning, just different change of personnel this morning. Same shirts, thanks gallery. Yes, it wasn't intentional. Rich is away somewhere, who knows where. They're all away at the moment. In Ibiza, apparently. I'm joined instead by Aaron, which is or Martin, as I used to call you. Which one are you?
I can confirm that my passport does say Aaron. So,
does it? Are you sure?
Yeah, absolutely, absolutely. I'll double check, but I'm pretty sure.
Good. How was your weekend, Aaron?
Yeah, very nice, thank you. How was yours? Quite relaxing.
Yeah, it was, and it's a lovely morning in London. For a change.
It is. I haven't been getting caught in the rain, which I have.
No. Was it last week where it threw it down? Was it the week before?
Well, my birthday is St. Swithin's Day, so
is it?
and it rained this year. So,
excellent.
So I think we're in for a rotten summer.
40 more days of rain. Those of you who know St. Swithin, Anglo-Saxon Bishop of Winchester.
Exactly.
Good. So let's go. What's coming up? Because the gallery is making me move on. Coming up, we've got 7:40 overnight action with me and Aaron. I'm going to call him Martin at some point. And 8 o'clock, of course, the opening bell as European markets get going following that trade deal with Trump. That's once again the two of us. And then 8:15, fast markets will cover. Oh, we'll think of something to cover. There's loads going on this week, so plenty going on. About. And then at 8:35, this isn't right. There's no Axel Rudolph. He's still in Turkey. The technical analyst for pros, apparently, is a replay. Oh, it's a new series, the gallery tells me. Excellent. They do know what they're doing more than I do. 9 o'clock in the morning, they're going to hate me for this. All sessions opening bell with Garth McKenzie. And then at 9:10, it is me again, unfortunately. We're trade of the week, and technically speaking. So we'll be looking at last week's trade and trying to work out what we're going to do this week. And then at 9:35, Expert Edge, Angeline Ong and Bill Blaine. There you go.
Good lineup.
Good lineup. Very strong lineup to start what is a very busy week for markets, Aaron.
Oh, totally.
What's going on this week? What have we got?
Well, just
we'd love an economic calendar. Yes.
Just looking at my my calendar here. We've got the US job openings Tuesday at 3 o'clock.
The connoisseur's economic data, JOLTS, isn't it?
Exactly.
Do you know what it stands for?
No, I don't.
You don't know what JOLTS stands for?
Not off the top of my head.
Oh, it's a good question for the viewers at home. What does JOLTS stand for? There you go. Anyway, sorry, carry on.
EU GDP Wednesday at 10 o'clock. USA core PC price index Thursday at 1:30. And then the big one, certainly a big one that I keep an eye on, more than the JOLTS, is non-farm payrolls and the unemployment rate.
Non-farm payrolls
that is absolutely critical for policymakers, portfolio managers, strategists when looking at the strength of the US economy and comparing data in, with regards to interest rate forecasts, with regards to economic fiscal policy forecasts and trajectory. So that's a big one that we're going to get on Friday.
It is, yeah, fantastic.
We continue to see a strong US labour market.
Yeah, and of course. We've got another page of economic data, or is that it? So we're missing the two other things this week.
We have the Federal Reserve.
The Fed is going to make a decision this week again, which we've not got. I mean, full marks to the gallery for getting JOLTS on there and not the Fed. There you go. So there we go. Of course, that just comes a week after, just under a week after that amazing scene of President Trump and Jerome Powell.
Yes.
Be the most entertaining thing.
Have you heard the analogy of well, this was a strategist, and he said that the relationship between Trump and Powell is like a sort of an adult and a moody teenager, because one is basically demanding one to cut rates. The more he demands rate cuts, the more he's going to say no.
So Powell is the moody teenager in this scenario.
Exactly.
I didn't have that. I thought Trump would be the moody teenager.
No, in this scenario, it's Powell, because he's basically saying, the more you ask me to cut rates, the more I'm not going to do it, the more I'm going to be data dependent.
The more he has to do it, yeah. But it was I could watch that. I think I watched it 3 times. I could still watch it. It's the most compelling thing. Let's go straight on to overnight action. Let's move on to the fact we weren't going to have the Fed on this week. And Bank of Japan, of course, as well. So that's the other key one. But let's go to overnight action. So what do we have over the weekend? What's been going on with markets?
Well, from sort of a big picture perspective, we're just continuing to see highs of markets, continuing to see highs. FTSE's well above 9,000 now, and US markets. I think it's their 13th record high of the year, with the 4th or 3rd just being set last week.
There we go.
So we had about 3 record highs in a week. So we're continuing to see really strong equity market performance post the April lows, and positivity in regards to trade policy with the European Union.
Yeah, and it's not just the FTSE, is it? It's not just US markets, crucially. It's a lot of other markets, either at multi-year highs or indeed record highs. And of course, because the big news of the weekend, Trump got his deal. Chart off, please. I think we'll talk about that in a second. Was it a trade deal? Is it really a trade deal? It's not really, is it? I think
it's well, I think the I's and T's are still being ironed out. But I think any form of cooperation is good in the Trump presidency in regards to other governments, other institutions. We've seen the equity markets really, in this instance, really don't like the uncertainty with regards to policy. So any certainty they get with regards to policy is positive, and that's why you got, even in April, we had tariffs being significantly higher than what they'd been under Biden, obviously. But because they'd been slashed from those highs, and because more cooperation was seen, equity markets are obviously very much forward-looking. Ignore that, the fact that tariffs are actually going to come in, but there's this sort of positivity that there's going to be a slightly better outlook. So I think that's what markets are looking at, and we've seen obviously a real change in the policy, and this hyper-inflation being forecasted is perhaps off the agenda now.
Yeah, it is really, isn't it? And this is the thing. There's the trade agreement. It's not really a trade agreement, is it? Because you don't hash out trade agreements in 45 minutes at a Scottish golf course. In fact, what it is, and I think this is very much the mood music from the FT and Bloomberg, is the EU has caved in this morning. Because there's a really good piece actually on the FT, if we go further back, talking about how they had a plan ready to go. They were going to they're going to sort of oppose tariffs, they're going to announce proper retaliation, and then because obviously you've got however many members it is now in the EU, you couldn't get agreement on what to do, and as a result any retaliation just fell apart. So whereas China obviously went in hard, and we'll come to them in a second, the EU is essentially rolled over, and they're paying 15% tariffs. They're buying US weapons, of course, crucially. Trump is the global salesman. But markets love it, don't they?
They
markets
do.
Are really happy.
And we've seen it spill over into the more exuberant areas of the market.
Yeah, we can come to meme stocks in a minute as well. So this isn't taco, I think. This isn't Trump chickening out. This isn't him. This is actually him getting what he wants. It might be quite ugly. It might be a bit of a bully movement.
It's the art of the deal, as they say.
It is the art of the deal, as everyone keeps talking about. Of course, it's the greatest deal in world history, whatever he called it. I think that might have been the Marshall Plan, but we'll leave that one for later. This isn't Trump chickening out. This is him actually getting what he wants. He's managed to get the EU into line here. I think the EU is sort of ruining the fact they didn't push harder.
Yeah, I mean, for him, it's always been America first, and stopping other regions or trade blocs or countries gaining that hegemony which America has dominated the market with for years.
Yeah, exactly. And I just missed that comment coming through, but someone's saying 50% tariffs are better than 25% tariffs, but it's still higher. But if this gets factored in, if companies are taking this hit, inflation doesn't respond yet, and it hasn't, has it?
No.
Where's this inflation that we were promised?
You saw slight elements of it. I saw a strategist note that there are very small elements in import-related inflation. Those small elements were tight, like very small amounts, but not enough to shift the dial. So we haven't seen the all fearing inflation figures of inflation is going to be up 6, 7, 8%. From what are we at, 2.5, something like that now. So obviously, it hasn't filtered through into those figures yet. So that's why markets, as you said, are optimistic that these tariff figures are much more palatable for businesses and for consumers, and we're not going to see, what was it, 150% at one point, China-US tariffs. Fingers crossed for essentially businesses and consumers, and it makes them really, much for them. It makes things much more straightforward for them to plan their costs and their outlook at earnings calls, which I think we've discussed before. But that's almost as as important when you're giving a sort of forward guidance at an earning call of where things are going to go. People in sort of Q1 were saying, well, if tariffs are at this level, we expect this. If tariffs are at this level, we expect that. Now we've got a bit of more of a unified picture, which is important for markets. And for sort of the trajectory of firms.
It looks far more normal than you had back months ago, and it was Delta essentially giving you two different scenarios, good and bad for earnings, and others just pulling guidance entirely. So now you've got something that you can plan against. As you say, if you've got uncertainty, you just don't know where you'll be, but now at least you can price that in, you can adjust in terms of your commentary around it, and it makes life so much easier.
Reminds me a bit of how airlines use derivatives to buy their often fuel contracts, so they know what they're paying.
Exactly.
And they're not at the behest of volatile commodity markets from time to time, and that's obviously a huge factor for their profitability. And
so often you see, the oil price has gone up, a little bit airlines. No, well, not yet, because they've already hedged this out.
Yeah, it can work both ways. If you get during COVID, I remember the airlines were obviously, paying top dollar for pre-ordered oil with derivatives.
Stuck with it when it was trading at ridiculous levels.
Yeah, $10 a barrel or something. Yeah.
There we go. But we did get a taco this weekend. More tacos were served up. Of course, stands for Trump always chickens out, as the FT coined. You can see on the screen, China, US to extend tariff pause by another. He does love a 90-day pause. Who doesn't love a 90-day pause, really, I suppose, in this sense? And this is my theory about tariffs. He's not actually going to implement them. He just likes to talk about them. Yeah,
well, it's one of those things where it's a bit of a power move for sure.
It's just maybe you can argue that because China stood up to him, because they've got bigger leverage than the EU or more effective leverage. The answer is there, stand up to the bully.
We know how intertwined they are since the late 70s, early 80s they are in the global economy. Yeah. But, we're very much reliant on Chinese goods and technology. So market's very happy with this dose of tariffs. So very impressive performance all the way around. So screen off. Let's go on. What else we got this week? We've got earnings season. We should talk about that. We've got a list of earnings coming up. No? Okay. I'm going to busk from my earning let me get the week ahead up and I'll show it to you, because we're coming into the nitty gritty, I would say.
Yeah, it is. The heavyweights really at the moment. Let's get onto this. If you can see, oh no, it's the wrong screen. There we go. Seamless. That's better. Using our own week ahead. The company announcements this week. It's a bit ridiculous, to be honest with you. What have we got? Boeing, PayPal, United Health, of course, Microsoft, Meta, Ford, Apple, Amazon, Strategy, MicroStrategy as was.
So really a juicy week, some of the real big names where we're going to get some interesting guidance, I'm sure, and what they expect based on, now this tariff pause, and also just what we've been seeing in that past quarter, whether they felt that certain policy that had come in under the Trump administration, whether that had seeped into costs for the businesses. And if that's the case, then we could see some volatility, both on the upside and the downside. I think it's always important to talk about both, because if we get a nice positive surprise for some of these companies saying, well, actually, we were not affected as bad as we thought, then we could get a nice pop in some of these stock prices.
Yeah, exactly. And this is interesting, of course, when you've got markets. Oh, look, we've got a proper earnings calendar. There you go. A more effective one. So you can just see that there must be a massive slice of the S&P market cap that we're reporting.
Yeah, I mean, you can see the likes of Apple, Microsoft, Ford, and really a real mix of different sectors there, which I think is quite important as well.
And it's 4 more of the Magnificent Seven reporting. So you've got Meta, Microsoft, who else we got? Amazon and Apple. There you go. So we've had Tesla and Alphabet last week.
Nvidia's later on.
And Nvidia, for some reason, loves to go right at the end of August, just to be different.
Along with Nike, they're also a very late earnings caller. They're usually one of the last for some reason.
Yeah, exactly. So there we go. Very, very solid start to the week.
We mentioned very briefly earlier a little bit about the meme stock mania. So that's coming back into markets.
So why has that come back again? You sitting there in your institute with your fund manager hat on. Why is that coming back in again?
Well, it's a sense of euphoria, I think, entering the markets. Of people feel when there's an immense amount of optimism, which we've seen with markets trading at all-time highs. People will look for other interesting areas of the market to profit on, and it's not quite the same as what we had in 2021, which was the likes of Wall Street bets users on Reddit targeting heavily shorted, poorly financed businesses. But we're seeing, I think, Open Door. We're seeing the likes of Krispy Kreme is another one, which has been GoPro's another one, massively.
GoPro. I remember when, no, this is me being old, I remember when GoPro listed and it was obviously the new thing. And the world of, well, you had a camera and this was even after the iPhone comes in. So why they thought that this would be able to justify this valuation and continue to rise from there, why they thought this was right. So talk about a fallen, not even a fallen titan really, but GoPro just...
A fallen something.
Fallen minnow, that's not very exciting if you drop a minnow. But yeah, you look at this, okay, on the daily chart, you've seen it go, what, from 45 to 200? But
yeah, so it's 400% or something.
Yeah, years ago, trading up at 12.15, it's a ridiculous amount of shareholder value destroyed there from a company that really hasn't lived up to its charm. But these are coming through because they're heavily shorted.
Well, I'm not
mostly. Yeah,
I would say that it's elements of exuberance in the markets, and for
rational exuberance, as
potentially
somebody once said.
Yeah, I mean it's certainly a case of people looking at areas where they feel confident to do that, and you know, you see elements of this in throughout 2021 with the likes of, you know, NFTs and that stuff rising in value massively and then crashing back down. So I think if you look at sort of the more bearish fund managers, they're certainly concerned when you see like the bouts of meme stock mania.
Oh, bearish fund managers are going to be bearish. There's a surprise.
But this is potentially a canary in the coal mine.
Do you think so?
Well, potentially, because it shows you know, spare cash being used.
Oh, there's froth around. But is it just a small scale, you know, revival of what was before, and just because these are heavily shorted?
I think because we've seen it once before and it's become almost like a cult thing where people buy these very, you know, poor stocks in the sense that the fundamentals aren't great and the business outlook's bad. So there's an element of that as well. I wouldn't use it as a tool to forecast global, you know, economic outlook, but it's certainly something to keep an eye on from sort of a cult perspective and a just a sort of an outlook perspective, really, in terms of why is this happening, what are the reasons for it happening, and is it going to continue another?
Has it got much further to run? Because of course, last time round it fizzled out once they'd moved on from GameStop and on AMC. And then they went to try and do it in silver and realised that you're playing in a very different market.
Definitely,
very dangerous point. But let's go to the Dow and see what we can get. I'm just going to get my screen up on this one because we should talk about this. 45,000 for the Dow.
It was 30,000. That was when Trump was in his first term. That was his big moment, was saying Dow 30,000. Now we're well past that.
Yeah, I've got to go so far out to find that. There you go. So yes, 2016, early 2016. 20,000 in fact.
Yeah,
there you go.
That was his big moment, was when the Dow passed 30,000.
But another big round number, 45,000, and we closed above it, of course, last week. So that's a step change as well, isn't it?
Definitely. And I think, you know, this chart in particular highlights the moves that we've seen since the beginning of the year, and especially really since April. I mean, volatility would probably be a bit of an understatement, I'd say.
It's come back, isn't it?
Yeah. Well, from the beginning of this year, the moves have been, you know, up, down, and the speed has been pretty.
I think it's the quickest rebound in. Oh, I don't know. The stat escapes me, but yeah, definitely one of the quickest rebounds. The most
similar to COVID, I'd say.
Similar to COVID, because but always without policy response. It's just tariffs on, tariffs off.
Definitely, COVID. There was this just glut of money and loose monetary policy. And then it kind of made sense for markets to just go on a massive tear once they realised that it wasn't sort of a virus which would just kill instantly. It was, you know, that things were sort of more under control. Once that came back into the picture, you could sort of understand why things were regaining, even though the economy was in a real terrible state.
Yeah. Again, it's markets doing their forward-looking exercise.
Of course.
Yeah, of course. So we should talk about Ford, maybe car companies after the break. Really, it'll be a good one to cover.
Definitely.
So when we do guess the chart as well. So it's time for the guess the chart already. Oh, we do it now? We can do it now. Should we play it differently? We'll go with guess the chart into the break. And welcome back, everybody. Did you get it? We didn't. This had us guessing. The gallery's gone for a really nasty one this morning. In fact, I asked them which country it was listed, and his response was Japan. But there you are, Honda. Well done if you got it at home. I don't think anybody did. So
I did get it, but it was pure.
You got there eventually.
It was through a game of guess who rather than me actually.
His first guess was some Japanese makeup company, which is.
Yes.
Might say more about Aaron than we wanted to know on a Friday morning. But there we go. What a fun start today. Good one. Good guesses though. Evergrande, of course. Nintendo, but yes, I think we will let the gallery have that one.
They got us.
They must pick obscure companies from countries no one's bothered with. There we go. Good. Let's talk briefly about Ford and car companies. There was a good comment earlier about how Ford is facing increased competition, of course, and they will be paying higher prices than Japanese and European car companies, because if they're importing stuff with 50% tariffs on steel, they're going to have to increase their prices.
Certainly.
So how is this a win for the US car industry?
Well, it's a win for the US car industry if people would divert their hard-earned cash to US cars. That's I'd say would be the win, and I think that's what Trump wants. But I don't think Ford are at the forefront of electric car manufacturing.
No, I suppose not.
That seems to be the way things are going.
Apart from Tesla, of course.
At least for the moment.
Yeah.
Tesla.
What else would we have?
I think the Chinese manufacturers are obviously really doing quite well in with regards to that, and you've got the likes of some of the Europeans now shifting, Mercedes,
storming ahead,
BMW, really, and Toyota, those sort of names really pushing for that. So interesting to see where this goes, whether the electric car thing continues or whether we see, reversal in that, because Trump has obviously, been quite, keen to sort of roll back on some of the greener initiatives in the previous presidents have put forward.
Yeah, exactly. And then, of course, the idea of this Japan deal was that Americans would be able to sell cars in Japan, and yet no Japanese person wants to buy a big American car today.
No, and I think that's a testament to sort of how good the Japanese cars can be.
And how big American cars are, and how they just get in the way. So there we go. So it's not supposed to be a great performance there for those US car
And this
companies.
is an interesting comment. Ford inventory up 20% from last quarter. So potentially they're struggling with to
shift this stuff.
Absolutely. It's just being held on file, or well, not quite on a file, but in a storage unit, garage.
So let's talk about this Nikkei, because that had a huge boost last week, didn't it? Off the back of we do care about the index gallery. It's the companies in the index nobody knows. I thought I did F11, didn't I? There we go. So it's just coming off 42,000 on the Nikkei. That was a record high as well, wasn't it? I think.
Yeah, I mean, the moves we've seen in the Nikkei as well. I mean, I feel like I'm repeating myself here when I talk about equity indices this morning. But yeah, I mean, sensational, really. We've seen, obviously, it used to be known as the widowmakers trade, and when I sort of came into the industry, people would allocate into this with caution. Even sort of in sort of late 2010s, early 2020s, people would be quite concerned with their Japanese allocations. And now we're seeing it perform exceptionally well.
Yeah, doing really well. I mean, there's a lot of value stuff in Japan, which always made it was attractive. Was it Japanese broker deals? Was the stuff that Trump was buying?
Yeah,
but not Trump. Buffett.
I think that Japan is kind of in its literal own time zone, but it's also in a unique scenario where it's obviously got an aging population. The monetary policy stance is very, very different. Yeah,
although it's beginning to tighten now.
That's the thing. If it tightens, and we've got inflation again, which is like inflation in Japan is obviously unheard of. What's going to happen to equity markets if we see mass tightening? Even if it's on the margins relatively small to what we're seeing in Europe and the West, but if we see yield curve control really come to an end, and rates obviously come below zero, what will that mean for Japanese equity markets? Will people get spooked there?
Yeah. Will they still love it though? Is it enough to be attracted? This is the thing. Will it be a beneficiary of all the people going back into equities globally after being scared out?
Exactly.
In April, will it just continue to be a case of buy US, which is the most important thing?
Sure.
Really. So there we go. There we go. 10 seconds, less than 10 seconds to the opening bell. I'm going to ring it again. There you go. Off we go. A new week begins on the London market. What have we got moving? Let's see. Opened out the gate, you've got JD Sports up 1.5%, Mondi up 1.4%. They're packaging, aren't they? Mondi, I think.
Yeah.
BT. I'm not going to make Aaron guess the epic codes because we did that once before and that went really badly. BT Group, Barrett, also up 1%. BT Group down slightly. Intercontinental up 0.7.
A lot of good moves there. A lot of positivity we're seeing. Only a couple of stocks in this view which are showing negatives.
How am I zooming in? Nope, can't do that. There we go. What have we got on the downside? What's moving down this morning? Oh, just 4 fallers so far in the opening part of the session.
British American Tobacco. I wonder if they're feeling the pain after the disposable vape ban a little bit.
Oh, that's true.
Yeah.
That's been a major growth area for them, isn't it, really?
Definitely.
So not too much. Oh, let's just refresh that list. Let's get it moving again. Okay, a bit more moving down in London. So BAE Systems off a touch. Imperial Brands slightly lower. BT Group.
And Relex, well, Relex was down marginally, but it's now up marginally, and that's been on a real tear.
It has been on, hasn't it?
Yeah.
Good performance. A few others. European stock, I think Rheinmetall, gallery tells me, is up this morning. There we go. WPP, oh, that's interesting move out the gate for their struggling advertising company. So that's currently what the rises and fallers. Let's get that back up again. There we go. St James's Place, 1.7. JD Sports also up 1.7% at the beginning of the week. So clearly a bit of strength there. And there was some news from GSK this morning, I think. There was a drug approval or something. So there you go. AstraZeneca and GSK, both big heavyweights in the FTSE 100. What else have we got reporting this week in UK-wise?
UK-wise, let me have a look.
See if we can get that up on the list. Let's get this up. Let's go to this screen again. There we go. Apologies for zooming in.
Regs we've got.
Yes. HSBC. So that's the third biggest. Miners as well. Anglo-American. Very, very busy week for UK. And of course, everyone's favourite, Rolls-Royce.
Been on a fantastic run.
Yeah.
I've been a very happy shareholder in Rolls-Royce, I have to say.
Good performance from them. What else is moving this morning? Let's go back to platform and see what we've got. Bit of early strength. And the DAX giving back some of those. That's overnight strength from the trade deal news, unsurprisingly. So we come off, about 90 points or so off on the DAX from those overnight highs. We'll see whether that reverses itself as trading gets underway, but just a little bit of a sell the news event perhaps on the trader, because it was stronger on Friday, wasn't it?
Yeah.
There was optimism.
Exactly.
Somebody thought something.
And it was almost like it was already priced in, I guess you could say, that people knew that this was coming, and it's like, well, it's here now. What's next on my agenda? Yeah, that would be the irony of the situation, wouldn't it? If you get trade deals, tariffs go away as a problem, and then suddenly it's buy the rumor, sell the fact. Exactly. Good. Let's go on to commodity prices. See what we've got moving there. Natural gas down again this morning. Oil prices up a little bit, 0.7% for both of them. So still there with oil. US crude really interesting because it's just hovering around that sort of 64.60 mark. Yeah. The thing is with crude, if geopolitical events come back, then we could see big moves in oil. Both upside, downside, as we saw a lot last couple of months in June with the flare up in the Middle East. I'd say that a lot of geopolitical strategists are saying that it's potentially not over yet, even though that things are in a bit of a lull. So that's, I think, an area where a lot of people are going to keep an eye on to expect sudden moves in this area. And also if we get a softer economic outlook, even though it looks like we've finally got that soft landing, if the outlook changes, especially with tariffs, commodities tend to suffer. Yeah. So another one to keep an eye on. A lot of strength in oil prices though around that level, 64. So that's really interesting to see. So there we go. And let's stick with commodities. Where's my full list? Oh, there we are. Let's get that going. So we've got also gold, of course, everyone's favourite. Well, it's given back a bit recently. Yeah. What's driving that, do we think? I think it's elements of profit taking, for sure. That's definitely something which is pushing that trend for sure. I mean, we've seen gold, I think it's up over 30% year to date.
Yeah.
And just elements of, there's now alternatives which are doing well. So obviously a lot of the fear you can see in April, the massive move upwards we saw as equity markets were selling off, because gold is obviously traditionally a non-correlative asset to the traditional asset classes. So yeah, I think there's elements of now, you can see sort of from May time with a little bit of, I mean, there's volatility, but not a huge amount of tremendous gain within that period.
And now we've got a screen off, please. And now we've got, of course, tariffs. Well, not tariffs, but the deals in the news. And as you said earlier, the uncertainty's gone away or is going away.
Yeah.
Is that going to be tough for gold? Is that going to mean that you've seen the highs, at least in the short term?
Definitely. I mean, the other thing I would say, which is positive for gold, is the de-dollarization trend, I'd say. That's definitely a tailwind. You've seen weakness in the dollar. I mean, it's 136. It started the year in sort of low 120s region. So that's, I'd say, is something where you might see a little bit of positivity towards gold. And also the monetary policy outlook will be quite interesting. So yeah, that's I think, you know, often gold, people look at sort of the opportunity cost of holding gold, and if you see yields come down, if rates come down, then, you know, it could be potentially supportive for gold. That's always the thing, because you know, if people can get higher yields elsewhere, they might look for sort of a cash flow generative asset rather than you know, a historic metal which doesn't have any underlying cash flows from sort of a valuation perspective.
Oh, Warren Buffett's entered the room. There we go.
Well, I'm just talking from sort of a valuation perspective, but obviously for a portfolio and for investors, there is a huge role that gold plays in portfolios, in the sense that it has this sort of non-correlation to traditional asset classes, and it's really quite useful in times of uncertainty.
Why is it not correlated to other asset classes?
It's just, it's got this traditional safe haven status. So we've as part of my role here, we help, you know, and we analyze and build portfolios, and we do things such as correlation matrices, which shows how well asset classes move from -1 being perfectly negative correlation to 1, which means they move exactly in the same direction. And gold to equities is usually, I mean, 3 years rolling, I think we've got it 0.2. So obviously there's a bit of correlation, but enough for it to be non-correlated, classified as non-correlative. And it's just seen as a traditional safe asset. It tends to outpace inflation over the longer term, and it's just what people can, I guess, people physically have had over time to sort of shield themselves from uncertainty.
Okay. So you've seen, of course, it's a huge rally this year and it's sideways. The risk, I suppose, for if you're a fan of gold, is that it keeps going sideways.
Yeah.
You don't have a massive sell-off, but nor does it continue these huge gains. By any metric, it looks...
Yeah, these gains have been like equity-like for sure the past, you know, 3 years. Quite exceptional gains. I mean, that if you didn't have spot gold right in the middle there, you know, I think many people would just assume that that's sort of a tech stock. Yeah. Which is quite remarkable, really, even from sort of 10+ years of. Yeah. I mean, it looks like a stock which has had really strong earnings over time. If you just look at the line and the trend there.
Yeah, I suppose if you look at that long-term view, you had the surge post-COVID, which took us up to nearly 2000, and then we didn't break that until March of last year. Yeah. So you had essentially in gold 3 years of sideways movement. Just couldn't break 2000. So it got there, not back again.
And then it was the Ukraine time. It sort of really had a bit of a spike upwards. At the beginning of 2022.
Then that didn't last.
No,
and you had another bit of pullback. So I suppose the risk looking at this chart, if you're looking at gold now, is to think, oh, we've had a fantastic run. It's got to continue. But it's, I think, much more plausible that you get to another sideways consolidation. Now, it's not necessarily the case that we chart off, please. It's not necessarily the case that we will go on and on in that. It's not another 3 years of going nowhere. I think it's the risk you get.
Yeah, and I think with gold, there's just so many factors affecting it, more so than potentially some other asset classes, you could say, which is why there's always commentary on it and why it's always sort of had a place in many different portfolios, I'd say.
And then last one before we go for break, silver. That's not a bad performer either. Had a bit of a...
I think it's performed better than gold, actually, in recent months.
It has, doesn't it, I think, in terms of actual performance. So you can see that they're coming right back. Just not back to 38, but recovering. And again, really there's a long area of support, so sideways consolidation in June, and then off to the races again.
Yeah.
But that's a very strong trend, and as you say, perhaps looks a bit more compelling.
Absolutely.
Gold.
Yeah, absolutely, and comes with, I'd say, more volatility than gold. So
Yeah,
something
very
which
much so.
should investors should tread with caution.
Cheaper but more exciting cousin.
Definitely.
So there you go. Good. I think we got time. I think we got a break now. You're off to Edinburgh.
Edinburgh Fringe, yes.
Ah.
Yes. So
we take. He's not performing. Thank you, gallery. You're so kind. So any suggestions of what he should see?
Definitely put them in the comments if you've got any show suggestions of what I should book. Including
that ex-SMP woman, Mahari Black. She left the SNP over the weekend.
Oh, she was one of the youngest MPs.
Yeah, she left about 21 in 2012 or so, wasn't it?
Yeah.
Good. See you in a mo.
In the last video, we talked about earnings per share, or EPS, using pizza slices to explain how much of a company's earnings you, as a shareholder, would get for each slice or share that you own. But today, we're taking it one step further, and we're using EPS to calculate the PE ratio. And this will help you understand what a share price actually represents. The PE ratio stands for price to earnings ratio, and it's one of the most widely used tools to measure a company's valuation. But what do I mean by that? Valuation is essentially the price you pay for something compared to what you get in return. Is it worth it? Whether you're buying a car or a house or shares in a company, valuation helps you decide if the price you are paying is fair. Now, in the stock market, what you're getting is a share of the company's profits. The PE ratio tells us how much investors are willing to pay today for those earnings. But why is this so important? Because it helps us compare companies and decide whether an investment looks cheap or expensive relative to others. Now, let's take a British construction company, for example. Imagine this one block is the company's EPS, and that is £1 per share. When you're buying a share, you're buying into the future profits of that company. But to avoid overpaying, you need to know how expensive the price is. Now, too many people jump in to buy a stock just because they love the company, without paying attention to the price they're actually paying. And it might sound crazy, but a share price alone doesn't tell you how expensive a stock is. The valuation does. Now, this is the important part to get. If the EPS is £1, then how many blocks of earnings am I willing to pay for a share? What's the right price? Is it 12 times or £13? Or if our construction company's PE ratio is 14, that means investors are paying 14 times the current earnings to buy a share in the company. So the share price is simply 14 times or 14 blocks built on top of each other. Now, why have I chosen 14 times? Well, that is actually the price of the FTSE 100. Adding all the profits together of the top 100 British companies and then dividing them by the number of shares, we can say the FTSE 100 is trading on a PE ratio of around 14 times 2024 earnings. Now that looks fairly cheap relative to its own historic PE of 16 times. Now the PE ratio can be seen as a snapshot of investor confidence. A lower PE ratio might suggest that investors think the company and their profits aren't growing very fast, while a higher PE ratio often means investors are expecting big things in the future. Now let's compare our British construction company, or the FTSE 100, to the S&P 500, which tracks the 500 largest companies in the US. Now its PE ratio is currently 24 times earnings. And that means investors are paying 24 times this year's earnings per share in the S&P 500. And you can see the difference right here in that valuation. That's very expensive relative to its own historic value of only 18 times earnings. But here's the big question. Why is the S&P 500 trading so much more expensive than the FTSE 100? Is it overpriced? Or are there other factors at play? Well, that's what we'll explore in the next video when we look at something crucial, the earnings growth.
And welcome back to Fast Markets. The gallery says I can finish at 8:15, so that's us done now. We're going to go now. There we go. Do keep your suggestions coming in. Thank you, Julian, for that suggestion. For Aaron, I'm not going to read out on air.
I think I'm going to give that one on a miss.
No, we're going to make you go now, and I expect photographic evidence. So I don't know.
Oh, okay.
There we go. Who'd have thought you'd get that? But there we go. So let's talk about the first one. This is my recommendation. Well, not recommendation. This is my suggestion this morning. Don't use the recommendation word, Christopher. Cranswick, which is about the only UK company of note reported this morning, and is a sort of mini guess the company. And no one knows what they do because Aaron didn't know, and most people don't know what Cranswick do. Good numbers though. I think very solid trading update from them. I like that's a trend I do like. That's a price chart.
Yeah,
that appeals to me.
You can see little bursts of action throughout there.
Yeah, very, very solid performance, and shrugged off the tariff stuff. And again, 46 pounds a share, big support coming through there. So I like the kind of share price chart because it's a company with the earnings going up and the share price chart's going up, and it's a kind of double tick.
You can sort of see when they've sort of had positive earnings, I think, with that big green area there.
It's not the most heavily traded company in the world. So any guesses on what they did? Let's take the screen off quickly for that one. No one impressed with what they guesses? No, they make sausages, pork products. So the puns write themselves when you're writing about Cranswick. They're very easy to write about that one, bringing home the bacon and so on. But we had a request for Albemarle Group in the US, which is chemicals jogger. So I don't know what the attraction of this one is. Let's see what that one is. Oh no, that's the wrong button. Chemicals firm, hell of a run higher. But what is that? Is that the beginning of something, or is that just the beginning, or sort of a short-term counter-trend bounce?
I mean, we've seen, definitely a bit of positivity sort of on the upside there, but sort of in the more recent months. But yeah, really, really intense move downwards, sort of from sort of longer term from 2022.
So that must be a value trade jogger, clearly. Must be getting cheaper. What's the PE ratio on that now, I wonder? Not a great performer. There we go. PE ratio. Oh, because it doesn't make any money. Their forward PE about 18, so nothing too aggressive, but keeps getting cheaper and cheaper. Poor old Albemarle Group. I wonder if that's a change now with the tariff stuff in the news, where that gives it a bit of a bounce.
Certainly.
A catalyst to move higher. Not much to talk about in that one. And then, Euro Stoxx 50. Bit of a slight change away from the normal. So obviously the DAX, the CAC is really interesting. And this is your pan-European stuff, isn't it?
Yeah, absolutely. So it gives you a real flavour of what some of Europe's biggest companies are doing in the index. And I mean, similar moves in other big indices, sort of from April, big sell-off, recovery, and now a slight move higher above the all-time highs. But it's, I've been quite impressed with European markets. I'd say for the past, certainly past year, I mean, we've definitely seen a really strong trend upwards, driven mainly by the DAX. But I'd say year to date, when that new sort of infrastructure defence bill, trillion euro, I think over the lifetime of it.
The big story.
That was, something which is quite critical, because I think Europe for a while has been trading at quite a significant discount to the US market, but it needed that impetus to trade higher.
Yeah.
Because the valuations might be attractive, but if there isn't that catalyst for people to be allocating to that region, because the narrative is positive for the US environment, then why would they buy it? But then obviously we had that defence and infrastructure bill came to fruition, and that's really positive for European companies, I would say.
And the problem is that the European companies aren't expensive and they do okay. They just don't have that same combination of profitability that the US has.
Definitely.
So it's always a time to buy Europe. is designed to buy Europe, and it does okay for a while, and then the US.
And then finally, though, it seems to be the time, or has seemed to be the time to buy Europe.
But then you could have bought into that euphoria. This is the weekly chart, and it's from March of last year, and then it went nowhere. You had
Indeed.
9 months, almost to the day, 9 months of sideways movement.
Well, I think this shows that often with Europe, it's you have to allocate to specific areas potentially. So with the DAX, you wouldn't have had that issue. But with Europe on aggregate, there are definitely some areas. I mean, the CAC 40, I think, has struggled relative.
Yes,
to
we
the
had people
DAX.
asking last week, when is the CAC finally going to come?
Yeah,
into its own?
people have
Why
been
is
very
it lagging
disappointed,
behind?
yeah.
It's still well below those summer highs.
Yeah,
below the
really
highs from
poor
May last year.
performance. Yeah, from relative to the DAX and even the Euro 50.
Is that's a combination, I suppose, luxury not doing well, and you've got France, political turmoil as ever.
You just laughed after France.
Sorry, I just can't help it. It's just that sort of standard what happens with France in the uncertainty with the budget and stuff.
Yeah. I mean, a lot of uncertainties from the sort of political side of things. With I think it was last year Macron called the election, and it was more left-wing parties came to power. We've had numerous prime ministers come and go within that time. And
of course, that was a great time to buy because the bearishness around France was too much.
Yeah.
It was about to fall over there and then.
And
it didn't.
There's been always the odd bout of civil unrest in France. There hasn't been for a couple of years, I don't think.
Yeah, it's quieting down, isn't it?
Yeah.
So we'll see where we go from there. Okay, so Albemarle was lithium as ever, everybody's favourite. Everybody loves a bit of lithium at the moment, so that's good. What else have we got? What's it? Ormat. Now this one's a new one on me.
The same for me. It's not one I follow.
Listeners at home, Aaron hates this when we give him random companies. Very much a top-down indices sectors, man. It's a tech company, yes. It's a technology company because how would you know that without reading the word technologies in the name of the company? But what is it? Sorry, what is it? Geothermal energy. There you go.
I believe Iceland are one of the best at that.
Okay.
That's 100% of their energy. When I went to Iceland, I was told, or something like 90% of their energy is geothermal because they've obviously got huge amount of hot springs there.
Okay. Plenty of hot air. These ones are in Nevada, though, so there's no Icelandic connection.
No, well, maybe they can expand their market.
Maybe so. So that's, again, very strong run. I'm just going off what the chart is telling me here. Decent trend. You'd be looking at that and liking it because it's obviously pushed on through these previous highs. Wait to see whether there's any bit of weakness. I don't know when the earnings are. Must know better than I do on that one. So, Ormat. Geothermal energy, very interesting one to watch, perhaps. Let's look at the longer term chart. That's not bad either. Usually zoom out on these and it's some horrendous slump in the previous 10 years. Earnings on the 7th of August. There you go.
That could be an interesting one for this stock.
Could be around to watch. One to watch around this sort of 10,000 level, which is where we got to.
It hit its 52-week high at $88.89 last week.
So that's interesting to watch. Okay, and then what else have we got in the last... China 50, China A50. Okay, yeah, because they had, again, it was the Japan trade deal stuff last week. I keep calling it a trade deal, even though it really wasn't a trade deal. And they've said, of course, this morning that the 500 billion that they're supposed to invest it's mostly in loans. It's not even in actual direct investment. Yeah. So China A50, though.
I think with China, you can get some enormous amount of volatility. I remember about a year ago, I think September 24, we had a massive rally on the back of sort of stimulus policy, and then it sort of petered
there you
out.
are.
Yeah, it was huge.
Huge hope of stimulus.
I was actually at an emerging markets conference the following day, and so everyone was obviously singing the stimulus's praises there, but it didn't last.
It has not lasted, has it? So if you bought it then, you'd still be holding the bag on that one, waiting for it to
trying to find an awkward exit.
Yeah. Well, as ever, all the markets at the moment, decent performance from those April lows, and the tariff China deal should provide a bit of positive boost to sentiment in the short term. Great. Chart off, please. Good. And then Wizz Air, that was Friday's numbers, wasn't it? I think Jay reported.
Yeah, they had a shocking day, down 11%, I believe.
Look at that move on a Friday.
Yeah.
Let's get the.
You ever flown Wizz Air, Chris?
No, I haven't actually. Eastern Europe mostly, isn't it?
Yeah, I've flown them to Poland before.
Okay.
Does the job, but I just struggle with the legroom because I'm quite tall. So,
Yeah.
And most of the height's in my legs, so that's the only criticism I have with there. But it's great apart from that.
Financial analysis. There we go. But there we go. Go from the lows of 972 on Thursday to absolutely stormy performance. So that is.
They're going under a strategy rethink as well. So they're slashing some of their orders of the A321 Airbus long range from 47 to 10 to 15.
Okay.
So maybe they're having a bit of a strategy rethink on routes and just growth outlook, maybe.
There's just one more thing I wanted to cover, which was there's a good piece on in the FT this morning on Greggs, because that's definitely worth reading. Talking about peak Greggs, if I can find it while I'm talking.
Well, it had a bad period because the weather was hot, which means people buy less baked goods, apparently. That was what I
won't have any bread today. It's too warm.
Well, yeah, I mean, people won't buy steak baked if it's too warm outside. That was what literally an article says that.
Definitely read this one if you can. 1 million sausage rolls a day, peak Greggs. It's fairly balanced, but it was saying that maybe it's essentially just cannibalising their own market at this point, and because they've moved on from just the sausage rolls or whatever, trying to be too clever, it's beginning to work against them. But definitely interesting read. Some great charts in there showing that. There you go. You've distanced the nearest Greggs, so that's a good bit of research there from the FT.
We've got one about less than 30 seconds.
Well, yes, yeah. You can be there really, really quickly.
Yeah, so we're never.
I still walk past it every day with disdain. I'm not going in.
You know what? You don't fancy a sausage roll ever?
No, not in the slightest. No.
Oh.
No.
I thought you'd be partial to one.
Me?
Yeah.
No. There we go. No, Scotch eggs, not from Greggs anyway. So good. Thank you very much. Good. Final thoughts?
Well, I think an interesting week, as we said at the beginning. A lot's going on macro-wise. Unemployment figures are coming out on Friday. Non-farm.
Huge week. It's a bonkers week.
Yeah.
Really.
We've got the Fed. We've got this sort of tug of war from Jerome Powell, the stroppy teenager dynamic, with the stroppy teenager and the adult dynamic of one saying you have to cut rates, one saying I'm going to be policy dependent, data dependent, I should say. So really, really interesting to see how that goes. Obviously, we've only got two 25 basis points priced in for the moment, the first one coming in September. Whether that changes come Wednesday, Thursday time, we shall see. But, a lot to digest.
And riding on that.
A lot in the earnings space.
Yeah,
as well.
we'll know so much more about earnings by the time this week is out.
Yeah.
And then it really starts to drop off in interest.
And you could start to see, if the earnings are really positive and the outlook's positive, we could see equities move higher on that news because they'll say, well, this tariff debacle has not really fazed me from a sort of investment perspective because the companies are still posting good figures. Alternatively, the opposite could happen.
So it might go up. I've got to take Mick and say it might go up, might go down, but it's fair enough because
it depends on what they say.
There's a lot of good news baked in at the moment.
I'm being data dependent, Chris. I'm following.
You've got to be data dependent.
Yeah.
That's all you can be at this point. Even Jerome Powell doesn't have a crystal ball.
No.
Although for one thing, you can be certain that whatever he does, he'll be in trouble with the White House.
Oh, absolutely.
So he's probably been glad of a few days of Trump being away in Scotland because it certainly promises to be a fun week. Thank you very much, Aaron. I think we've managed to cover most stuff in that.
That was good fun. Always a pleasure.
All the way. Thank you very much, everybody. Don't forget to like and subscribe. We'll be back in about 5 minutes with, of course, Axel Rudolph.
Take care.
In the last video, we talked about how the S&P 500 has a higher PE ratio than the FTSE 100 because investors expect faster earnings growth. But let's look at what happens when those earnings actually grow and why that makes such a big difference. Here's the S&P 500 in year one. Its PE ratio is 24 times, which means investors are paying 24 times the earnings to buy shares. This tower represents the share price. The height of each block reflects the unit of earnings needed to support that valuation. Now, let's jump forward to year two. The share price hasn't changed. This tower is exactly the same height, but look what's happened to the earnings. Each of these larger blocks represents higher earnings compared with the smaller ones from year one. Because the earnings have grown 50%, what used to be 24 times earnings in year one is now only 16 times earnings in year two. That's a huge improvement in valuation, even though the share prices have stayed the same. This is the power of earnings growth. When companies deliver stronger earnings, the PE ratio naturally comes down, making the stock look cheaper, even if the share price hasn't changed. And when investors see that kind of growth, they're more likely to stay invested or even buy more shares. And that's what pushes the PE ratio back up. And that's what makes shares go up or down. Now compare that to the FTSE 100, where earnings grow more slowly. Even if the share price stays the same, the PE ratio doesn't improve as dramatically because the earnings aren't growing as fast. That's why growth is such a critical factor in investing. It's what drives long-term value. So here's the big lesson. Earnings growth doesn't just boost a company's value. It makes the stock more attractive by improving its valuation over time. As an investor, the holy grail is to find companies that can grow their earnings by more and for longer than other investors may already expect. This may even mean avoiding shares that are already very popular, overowned, and potentially overvalued. Because if a stock on a very high PE ratio misses its earnings estimates, then the price can come crashing down.
Hello and welcome to Technical Analysis for Pros, where I'll be looking at why you should always use a stop loss. Now, I imagine you bought the Ocado share at around 1,000 pence back in 2018 or perhaps in 2019, or you had another opportunity to do so around 2020. And then you saw the share price go all the way up towards the 3,000 pence mark. So you would have looked pretty clever. But had you not used a take profit stop or a stop loss, well, with the COVID pandemic, the Ocado share price fell down again, and you could have ended up, as you can see here, with a loss, even though you had multiple opportunities to get out around your entry level, around the 1,000 pence back in August 2022 and also in 2023. Because the problem is, if you still hold that stock now, you're basically trading at around 234 pence. So you've lost 3/4 of your investment just by holding on to that share price. That's why you should always use a stop loss or a take profit stop. It's your insurance policy. It's like having a car or home insurance, and it is your safety net when you trade. Because believe me, Ocado is not the only share that has done this sort of movement to the upside and downside, but it happens to all kinds of shares. The more shares you have, the higher the probability this sort of thing might happen to you in the future, which is why you should always use a stop loss. Thank you for joining me on Technical Analysis for Pros, where I'll be discussing support and resistance and how to correctly draw these areas on your charts and then use these for trading and investment purposes. So let's begin with a monthly chart of Ocado, and let's see where our support was back in the past. And what I want to do is I'll just draw a rectangle of where I believe support was in the past. So what I'm looking for is a cluster of previous lows and sometimes previous highs coming together, and then seeing whether these in the future could act as resistance or support. So let's just begin by looking at this chart here, and you can see what I've just done here is connected the June 2019 low with the low in November of 2019, and then the lows in February and March of 2020. So I had lots of lows which were quite close to one another. Now, the definition of quite close is obviously relative, but if they are on your chart relatively close together, then you can say, okay, that's probably a support area. And you can see every time we went down here again, at least if you go back to February and March of 2020, we retested this area where the lows in June and also in November of 2019 were made. So this is then where the Ocado share price moved up from that support area. Now, you leave that on your chart because in the future, it may act as support when the market comes back down towards it. Now, in this case, this acted as support here, and don't forget, this is the monthly chart. It did so in March of 2020. We bounced off that support area. And yes, in April of that year, we then fell through it. But what is interesting, and this is why I always leave my support and resistance areas on the chart, is that quite often that previous support area, because of inverse polarity, becomes a resistance area. And this is exactly what happened here in August of 2022. We bounced back here with the Ocado share price to that resistance area now, the previous support area, and failed here and came off again. So you can use this to enter the trade in the direction of the now downtrend to go short with, for example, and you could put your stop loss, for example, above that previous support area, which is now a resistance area. And you can see the same thing happened again here in June or July, I believe, of 2023. We tested that previous resistance area here from August 2022, which used to be a support area back in 2019, 2020, and that then acted as resistance, and we came off it again. So this is why it's important to draw these support and resistance areas on your charts. Another reason is, for example, here, what we can also do is draw in a resistance area. What I'm doing here is I'm connecting the highest point of an area where there was a cluster of previous highs and lows and see whether that in the future acts as a support or resistance area. So let me just do this again here and draw it all the way up to this high here. So basically what I've done, I've taken the highs on this monthly Ocado chart from March to May 2019. I connected these highs together, and that gave me this resistance area here for September to November 2019. So here that resistance area held. But then what we saw in March of 2020, let me just make this clearer here, is a break through that resistance area, but we didn't have a monthly chart close above that resistance area. So what you want to see, whether it's on the monthly chart, the weekly chart, a daily chart, or intraday charts, you want a candle to form which then closes above that resistance area or below that support zone to say it's a valid break. So in this case, what we saw in April of 2020 is a break through this resistance area, and for the first time, a monthly close above that resistance area, because this candle here, the green candle, showed you that the close was above its open, and that close was made above that resistance area. So at this point, you could have said, right, we've broken out of this sideways trading range, we broke and closed above that resistance area, and then we had this uptrend here take us all the way towards the 3,000 pence mark. So this is how I would have drawn my resistance area on this chart here and my support area on this chart. And you can do this on any time frame you look at. You just try to find a cluster of levels which are close to each other back in the past on the left of your chart, and then you draw a sort of rectangle around those, and those can then act as support or resistance in the future, which is why you want to keep them on your charts. Hello and welcome to Technical Analysis for Pros, where I'll be looking at moving averages. I've got a daily FTSE 100 chart here to look at, and you can see two lines on there. One is this orange line, and in my case, what I use is the 55-day simple moving average. Now, a lot of people use the 50-day, the 100-day, and the 200-day. I prefer to use 55 because it's a Fibonacci number, and I also look at the 200-day simple moving average simply because it's something that everybody looks at, even fundamental analysts, as a proxy for whether a market or an asset class is bullish or bearish. If it's above the 200-day simply moving average, that's considered to be bullish. If it's below the simple moving average, the 200-day, then it's considered to be bearish. Now, what I use the moving averages for is simply as a smoothing tool to see in which direction the trend is heading. So if you're not that comfortable looking at all these gyrations of a candlestick or a bar chart, just look at a moving average, and if that's pointing up, then the trend is likely up. If it's pointing down, then the trend is pointing down. We know all of that, but what I want to show you here is how I use the moving averages. And I like to use the 55-day moving average because quite often around it, you tend to find support. And you can see here on the FTSE 100 chart, on the daily chart, we had that back in January of this year. For 3 days, we held around the 55-day simply moving average, which acted as support. And we had something similar happening here towards the middle of January as well, where we held on a daily chart closing basis above this support, the 55-day simply moving average, before then heading up again. And what we saw here is also a golden cross. So basically you've had the 200-day simply moving average pointing up and the 55-day average pointing up and crossing from below it through the 200-day simply moving average. So both of these pointing higher, which is a golden cross. And then we had this nice follow through to the upside in the FTSE 100. Now, what we can also look at is then if you go to the right-hand side of the chart, the 200-day simple moving average. So basically we were trading back above the 200-day simple moving average from January of this year until April of this year, when the fear with regards to Donald Trump's tariffs basically led to this huge down move here, and we were trading back below the 200-day simply moving average before then reintegrating our bullish momentum here by trading above the 200-day simply moving average at the beginning of May. And what we saw then is the 200-day simply moving average being retested here at the beginning of May, and again for 2 days in the middle of May, where it acted as support, and then we went higher again. And then since then, what we've also seen is again the 55-day simply moving average, and it acted as support at the end of June, beginning of July, and again here around the beginning of July. So you can use your moving averages not just as a smoothing line of the underlying trend, but also as potential support or potential resistance on your charts. And just make sure that when you do that, you always keep in mind what the actual underlying price is doing, because a moving average is just a derivative of price and not the price action itself. And because of that, it is a lagging indicator. It is slower than the actual price action. Hello and welcome to Technical Analysis for Pros, where I'll be looking at moving averages. I've got a date. Hello and welcome to Technical Analysis for Pros, and today I'll be looking at Fibonacci extensions. How do you draw these correctly onto your charts? Well, let's begin by having a look at a monthly gold chart, so going back to the early 2000s, and you can see we had an uptrend from back in 2001 to the highs seen in 2011. So what you're trying to find is a major uptrend and then a downtrend against that uptrend, or a correction of that previous uptrend. And then from there, you basically measure the previous uptrend distance upwards to give you these Fibonacci extensions. So let's just do this together. Let's just draw these on our chart. We go on here, Fibonacci extension. We take the lowest level of our bullish move to the highest point of that uptrend here. Then you click on your mouse and then you draw this line down to the lowest point, which corrected this previous trend. And that was this point down there. And basically this then gives you the upside targets. So let's just do this again. So we go on Fibonacci extension, lowest point, click, highest point of the up move, click, extend it downward from the lowest point of the correction, click, and that then gives you this horizontal line here. So the 100% extension, Fibonacci extension of that move up from from 2001 to the high in 2011, projected higher from the low in 2015. That comes in at $3,745, 161.8 Fibonacci extension. So what we've done is we've taken this distance, multiplied it by 1.618, and then projected it higher from this low here. So that is the next upside target. And what you can do is sometimes you can put a cluster on there. So we could draw another Fibonacci extension and say, okay, let's look at our up move from basically 2015 to 2020, and then extend that higher from the low we saw back in 2023. And that gives you a Fibonacci extension which has already been hit. This is the 161.8 Fibonacci extension of this up move here, projected higher from the low seen back in 2022, and that came in $3,285. And you can see we've traded around it for the last 4 months or so. So these Fibonacci extensions basically give you potential upside targets, and they can be very useful if you are trading in all-time highs and you don't know how high a market can go in the future. You can draw these Fibonacci extensions on your chart, and then they might in the future represent possible up or even downside targets in a downtrend. And that could be something useful to know with regards to where you want to cash in your positions. Hello and welcome to Technical Analysis for Pros, where today I'll be looking at Fibonacci retracements and how to correctly draw these on your charts. So let's begin by having a look at this Vodafone share price, a daily chart and a candlestick chart. And what I can see here is a movement to the upside and potentially a retracement lower. And I want to know where that retracement lower may end in the future by drawing on Fibonacci retracements. So what I do is I go on here, do Fibonacci retracement from the lowest point of my chart to the highest point of my chart, and that then should give me possible areas where in the future the Vodafone share price might hold in case of it coming down. Now the problem with these extensions is that you don't know which of these is going to be hit. So usually what you have is 23.6%, 38.2%, 50%, that's actually not really a Fibonacci retracement, but that's still on there, and then the 61.8%. And then we have 76.4 or 78.6, depending on how you calculate it. But let's look at these horizontal lines and see whether they held a support or not for the Vodafone share price. And you can see here that the 23.6 was fallen through, but you can see that around the 38.2 Fibonacci retracement, we did hold in early June, and we held exactly around there on the 9th and on the 10th of June. And sometimes you have a little bit of movement through that Fibonacci level. It's not an exact science, but you could see here that you could say, okay, fine, we held for several days around this Fibonacci retracement support, and we also held above this previous low, and then we had a bullish candle here followed by another bullish candle, and that then meant that potentially we could be bouncing off that Fibonacci retracement level, and this is exactly what happened here. So these retracement levels sometimes are spot on, but most of the time it's the area around these, either 38.2, the 50% or the 61.8, that you should be looking at to see whether in this vicinity a reversal of the previous trend, in this case the downtrend here, the correction, is taking place, and you then resume the previous trend, which was an uptrend here for Vodafone. So this is why Fibonacci retracements can be very powerful, because once you hit one of those horizontal areas, these retracement levels, or come close to them, you then zoom in and focus on what the price chart is actually doing. You could look at shorter term timeframes and seeing whether you can see a reversal in the direction of the previous longer term timeframe trend taking place here or not. And that can be very powerful information with regards to your trading analysis and also your trading. So I use Fibonacci retracements as areas where I focus more on the price chart in the short term and as an area where I might potentially find resistance or support depending on whether we are in an uptrend or in a downtrend.
Okay guys, before I teach you how to use this, I have to teach you how to use this, the mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready, time to go. Hey, come on Pat, come on. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Bring me the next shiny new thing. Bring me the next shiny new thing.
We're watching a crisis unfold in the UK and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings-first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs, from scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
me the next shiny new thing. Bring me the next shiny new thing.
Okay guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat, come on. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money just sat in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest, and it's days like this. We get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically, in investing that you can from cash. And that's not saying people go out and take a load of risk. It's about education, and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash.
Good morning, everyone. This is Darcy McKenzie here, coming to you from Traders Corner, and I've been asked to step in and do this all sessions slot this morning. So I'm going to give it a go, have a chat about what's catching my eye and what I'm watching out for the rest of this week. Something just to start us off is obviously the S&P 500 is always a big one. That's something that I watch very closely. And as you can see, if you look at this hourly chart that I've got here, we have a fairly large gap up at the start of trade today. And that's got to do with the fact that the US and the EU have come to a trade agreement over the weekend. And that started the day with a little bit of a bullish bias. And hence you've got that gap to the upside, with the S&P 500 now trading north of 6,400. It's given up a little bit of the earlier gains, but nonetheless still pricing in a stronger start to trade when the US markets get open later today. Let's have a look then also at the German market, the DAX, because that's of course a huge recipient of this trade deal between the US and the EU. What's interesting to note here is that the DAX also started with a gap up early this morning in the Asian session, but you can see that it's bumped up against a zone of resistance here, which is at about 24,600. If we just zoom out a little bit on the chart, you can see that that's actually a region of resistance that's been an area where some sellers have come in over the last week or so. And we've actually had a case now where this market is dipping down off that early session high. And it's given back about 200 odd points from where it was trading earlier in the Asian session this morning. So it looks to me like we've got a little bit of a buy the rumor, sell the fact kind of situation here. Keep in mind that there was already this EU and US trade deal mooted last week. So to some extent that was priced in already. The other thing to look at is the US dollar basket and also the euro dollar pair. The dollar seems to have actually strengthened it. If you look at the US dollar index basket over here, that has pushed up quite nicely over the last couple of hours. So we've got stronger dollar, which is implying also therefore slightly weaker euro at this point in time. In terms of stocks to look at, let's just have a look at some of the German automakers. Let's have a look at something like Porsche, for example, in its all sessions trading. Let's have a look here. There you can see what happened. Porsche also started the session higher, but it's actually given up a lot of its earlier session gains. Again, looking pretty much like the DAX in the sense that it started strong, but we've got a little bit of a buy the rumor, sell the fact type of reaction to that as well. If we go and take a look at BMW as another example, you see something fairly similar over here. Same again, started pretty strong and dipped down a little bit and is actually trading slightly off or quite a bit off its earlier session highs. Go and have a quick look at Mercedes-Benz. Same again, you'll see there. Let's just get it up here. Likewise, Mercedes starting with a big move to the upside, but you get this long tail to the upside on that early hourly candle. So again, a little bit of a buy the rumor, sell the fact type of situation there. All right, so let's have a look at the American all sessions. Let me just get it up over here because the market has opened. We're now past 9 o'clock. So let's just get the shares window up here. Right, so here we have some big moves, or not such big moves, but Tesla is up 1.3% in the early sessions. And we've got MicroStrategy up 3%. Now that'll be on the back of the fact that Bitcoin has been pushing higher. I'll try and show you a Bitcoin chart in a moment. MicroStrategy is something I've been watching quite closely. I've actually got a trade on in this stock at the moment. Based on the technicals, I see it breaking up out the top of a falling wedge pattern over here. And also the chart of Bitcoin itself looks like it's starting to potentially build the potential for a breakout through the top of a bull flag strategy over there. Marathon Holdings is also trading higher, similarly on the back of a stronger Bitcoin price. What else have we got here in the American all sessions? Coinbase also up 2%, and likewise there, if I was to actually draw in some of the technicals here quickly, you'll be able to see that we've got again a bit of a falling wedge pattern coming in over here, and it's starting to break out through the top of that, similarly on the back of a stronger move in Bitcoin. Keep in mind this week we've got 4 of the Magnificent 7 companies reporting. We've got Microsoft, Apple, Meta, and Amazon all reporting during this week their second quarter earnings. Those are collectively $11 trillion of market capitalization that's going to be reporting this week later. So keep a very close eye on those as stocks that will be in focus. Also this week, we've got the Federal Reserve interest rate decision that'll be on Wednesday evening. That's going to be quite an important one to watch. And then the Bank of Japan also due with interest rates this week. It's important to note none of those central banks are actually expected to cut rates this week. But what's going to be most in focus really is the press conference that goes afterwards and what Jerome Powell has to say in terms of the outlook for interest rates going forward beyond there. Just want to look at the chart of Bitcoin because I did mention to you that is looking interesting. Let me just quickly get that up. Bitcoin trading right now about $118,800. But if we just quickly zoom out, let's just make it a 4-hour chart here. You'll be able to just see a bit more of what I'm referring to here and why we're seeing some strong moves higher in some of the things like, for example, the MicroStrategy and the Coinbase that I spoke about in the all sessions talk there. So that without drawing any lines on the chart, you've basically got what appears to be a bull flag busy setting up here on the price of Bitcoin. If it can break out above $120,000, that would be bullish. That would open another leg higher in my view. And I think that the longer this consolidates, the more energy it's effectively building up for that potential breakout to the upside. So if that's going to be the case, and again, then you probably are likely to see further strength in the likes of MicroStrategy and Coinbase and so on. Also important to look outside of just Bitcoin as well. There's a lot of interesting things happening in the rest of the crypto space as well. Ethereum, for example, has been very, very strong recently. Another chart that's for me is very much in my focus this week is this dollar-pound cable. The dollar, as I mentioned, has started to look like it's basing a little bit over the last number of days and starting to turn a little bit higher. The chart of cable is shown here, and this is a 4-hour chart. And I'm just going to zoom right out, first of all, and show you from a longer-term perspective what I'm seeing here. The price has broken this rising trend, which goes back quite a long way, back to earlier this year. And it's now rallied up, tested the underside of that trend at 136 into the end of last week, and turned lower now. For me, what's a big level to watch here is going to be 133.80, because that now looks like the neckline of a head and shoulders pattern there on this chart of cable. And if we were to see a breakdown below that level, that 133.80, then that would validate that head and shoulders pattern, and it would probably project moves down towards 132 and potentially even to 130, which are quite big technical levels. So I think if we get that breakdown below 133.80, that would imply some dollar strength, short-term dollar strength, and some pound weakness. And that's something that I've got my eye very much focused on for this week. Right, let's just quickly go back to the all sessions charts and have a look and just see if there's anything further that I can talk to you about. If we have a look at, let's just go through here. Okay, let's just have a scroll through here. Rigetti Computing is not open, but that's a stock I'm watching very closely. It's in the quantum computing space. It's been very, very strong. Quantum computing has really been a strong space of late. D-Wave Quantum as well. Also, that's trading up 2.5%, looking strong over there. Let's just quickly scroll down some more and have a look. Alibaba up 2.27%. Chinese stocks have also been on my radar recently. I was actually on with Rich last week before in the studio in London, and we were chatting about K-Web and some of these Chinese tech stocks and how that sector is starting to look quite good. Alibaba, obviously one of the big heavyweights within Chinese tech, and that's up 2.2% in after-hours trade here. ASML looks like it's making a bit of a recovery from last week's heavy sell-off, up 3.2%. So that's probably starting to find a little bit of a floor there at around about just above 700, and made possibly a double bottom there with that move higher this morning. Let's see whether that can actually follow through or not from here. Just looking through a little bit further, see what else we can find in terms of stocks to talk about in all sessions. Micron Technology up 1%, semiconductor space there. Obviously, semi is still very much in focus. This stock has been consolidating a bit over the last 2-3 weeks or so, but again, looking broadly speaking like it's still in a rising trend alongside all of the bigger semiconductor stocks out there. All right, I think that's it for me. I hope that's been helpful for you this morning, and have a good day and have a good week ahead. Thanks.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money just sat in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest, and it's days like this we get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically in investing that you can from cash. And that's not saying people go out and take a load of risk. It's about education and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
We're watching a crisis unfold in the UK and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs. From scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, Forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Bring me the next shiny new thing. Bring me the next shiny new thing.
We're watching a crisis unfold in the UK and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs. From scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Bring me the next shiny new thing. Bring me the next shiny new thing.
We're watching a crisis unfold in the UK and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings-first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs. From scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
Hello and welcome to Trade of the Week. It is me again, Chris Beecham. Axel Rudolph is still on holiday, lucky him. We're going to look this week at our Trade of the Week for the week beginning Monday, the 28th of July, the last few days of July, how quickly it comes around. Last week we looked at dollar yen, we'll come to that in a second, but this week's trade of the week is not spot gold. There you go, that's the wrong chart. This is the one we want. We're going to long crude oil. We're going to look at crude oil, which has seen a lot of support. If we zoom right in here, we can see over the last sort of month or so, a lot of support down here around the 64.40 level. While it has seen some limited upside up towards $68 a barrel, I think we're looking to see if we can get another bounce of support in this zone and push on, and maybe that will turn into something more substantial. So that's the trade of the week for the week beginning Monday the 28th of July. We're going long crude oil. For our stop, we are going to give it some room, so we're going to put a stop down here at 63.97. So a bit of a wide one on here, but the hope is that we will get at least a move towards $68 a barrel and maybe even something a bit more substantial. Maybe some optimism comes through in terms of crude oil. So that's the trade of the week. It's long US crude oil. To look back to last week's trade, a mixed bag on this one, I'm afraid. It started off well. We were going short dollar yen. We did get down to 146 by Thursday's lows, but after that Trump Powell drama on Thursday and Friday, we've seen a continued recovery in the dollar. Of course, we've not hit our stop yet, so we'll see whether it continues. So you could argue maybe the rationale is still in place. You could opt to leave it, or you might argue that maybe since it's bounced back to essentially to where we were a week ago, that the trade, it hasn't quite worked out, but maybe you can leave that one to run for the time being. So That's our dollar yen trade still in effect, although we've seen much of our profit eroded by the recent bounce in the pair. So that's to go back just to reiterate, that's our trade of the week for this week is to go long crude oil with our stop at 63.97. Moving on now to Technically Speaking, our first request coming in, hot off press, don't forget to get your request in for this so we can talk about them, is Palantir. Now, if you wanted my glib answer to Palantir, where's it going? Higher, because nothing stopped this one for months. Now, the more serious answer, of course, there is your uptrend. It is not one to be argued with at this point. If you look back from those February highs at 125, so we're going to go that previous high from mid-February. Then we eventually managed to get back above that during the course of May and into June. Now, the support in this latest leg higher comes from that early July low at 128.56. And that has given it the strength to push on towards 161. You've still got a very strong uptrend. As I say, you cannot really argue with this as yet. If you're looking in terms of a bearish view, it is very hard to muster one at this point, really. Where is the view coming from that you can support a short position, apart from the fact that it has gone up a lot and therefore is vulnerable, which could work out. But if you look, we're not that stretched in terms of distance from the 50-day moving average. If we dig out a measuring tool to see what the percentage movement on this is at the moment, because it's often an interesting thing to look at the distance between the price and the 50-day moving average, or you could use a different moving average. That's 14%. But that kind of gap has been relatively consistent all the way through this strong bounce from those April lows. If you look back to February, when it really did get overextended, and as ever, overextension is really the kind of thing you can tell with hindsight. But if you look there, the price on the 18th of February was about a whopping 32% above the 50-day moving average, which is merely a reflection of strength at this point. We'll see whether that continues, but you've got these three moving averages moving higher. You've got higher lows coming through all the way through on Palantir since, well, goodness me, down towards April, even before then, way back into the dim and distant past, i.e. last year, when you could have picked it up for $28 a barrel, $28 a share, sorry, if only you'd known. So very strong performance. If we put a trailing, asking if we put a trailing stop on Palantir, well, if we were going long, you'd probably look for it to have some distance away from it, really, but you can use a trailing stop in the same way that you would on the rest of the platform. Don't forget to use it here, and you might just really put it down. Well, around these previous lows, 146, 147 was a key area because that was resistance back in late June, and then also a bit of support coming through down on 22nd of July. So that's the key thing to bear in mind. You could use a trailing stop if you're long. If you're going short it, really, there's no catalyst at the moment. You'd need to see a reversal back below these 155 levels to see maybe there's some short-term top. But there again, though, it is still very much a very strong trend, and you'd be counter trending it, so it may not get much of a boost to it, really. So Palantir, your first one to watch of these tech stocks, so much back in fashion, really, after April, and it wouldn't be surprising to see us continue to move on to that. We could look at Goldman's, US banks, of course, another big driver behind the rally. Very positive performance from them in earnings season, all well and good on the bank earnings front. This one a bit more interesting because here is a classic case of actually talking about that distance between the price and the 50-day moving average. Doesn't always correct by going down. Sometimes markets correct by going sideways, a correction in time rather than price, which is a great phrase to wheel out if you think a price is going to go sideways rather than go down. Don't forget, as I constantly tell people, prices go up, prices go down, they also move sideways. They don't have to do either up or down. So we were quite overextended here for Goldman's, of course, much less exciting stock price compared to Palantir, but nonetheless a similar pattern applies, that you've had a big rally and then a consolidation, and now it does look like, he says guardedly, that we are breaking out of that to the upside. So the highs from the 3rd of June, 725.84 was the high. We are nudging through, in fact we closed above that on Friday, it's important to note, and beginning the week firmly higher. So Goldman's doing quite nicely. Whether that one has a much further to run. Of course, there's a lot going on this week with the Fed, and then your clear support. This is a good thing about these trading ranges, these sideways consolidations. 69.24 was your area of support, really. So a close back below that might signal that you do actually get a bit of a short-term pullback beginning, but certainly Goldman Sachs doing very, very well at the moment. Let's go on to gold prices, because that's always a good one to monitor for the time being. Don't forget to put the requests in if you've got any that we can look at, do them on the fly. This is, again, consolidation. It's the name of the show so far. I think I've used the phrase sideways consolidation about 6 times this morning, so I'll try to stop using it. But the point is that here is your peak in gold. Here is euphoria from the 22nd of April as tariffs were paused. And then we've spent the next 2-3 months going sideways. Now, of course, if you picked them up at the lows down here, if you picked up gold down at 3,200 and then maybe bought some more about the 29th of June, that is perfectly fine because you're buying those higher lows, but you haven't really had much in terms of a return on that. Okay, the first one did okay, but we've not held these highs. The price is just telling you something here that there isn't the buying momentum to drive this one higher in the way that it did relentlessly all the way through from the beginning of 2025. And a reminder that prices do not trend all the time. Sometimes they go sideways. It can be an absolute nightmare, but it is part of the game. If you looked at the FTSE from last year, that's another classic one where you had the markets moving very strongly higher in the beginning of the year and then no movement all the way through. If we go back, this is our monthly chart. If we get to the daily chart on the FTSE 100 last year, if we zoom out, here we are. All the optimism around the FTSE 100 at those highs, 84.30, and then sideways until January before it then broke out again. Of course, it was a bit of a false dawn because you had the drop in April. So sometimes it's not been great in terms of a firmly directional trend, but nonetheless, you do get these consolidations. They're not always going up or down. Sometimes they go sideways. Rank group request to come through also on this morning. New one on me, entirely new chart. Fantastic trend since the beginning of 2025. Beginning to see a bit of weakness that you can see really. Not divergence in terms of MACD and RSI, but definitely a lower high coming off the back of this huge rally. Prices do need to consolidate, much this key thing to watch at the moment. You went from the February lows down at 22.74 all the way up to 8,000. Now you get a move of that size, it is bound to consolidate, is bound to move sideways in the short term. Prices have to consolidate, they have to catch up, earnings estimates have to change. Essentially what the price action is telling you that the market is doing its thinking on this stock now after what's been an incredible run, because if you see a stock move like this, things have to be revised in terms of their outlook. So we're watching to see whether today's move, and already we're off the lows in early trading, so that's a positive sign. And you did see some buying coming through around 62.40 over the course of the last week of June, beginning of July. Whether we've got a bit of momentum finally to push through here. But if you look at the hourly chart as well, it's very much a case of selling the rallies, or certainly the buying pressure has just evaporated around the 72 level. So again, consolidation since Tuesday, the 8th of July. Whether this can change into something a bit more substantial remains to be seen. But it's just a function really of the fact that you've had such a strong move in these prices over the course of the last, since the year so far. To see a share price triple and more, you then have to take it has to have a pause for breath. Let's move on. Let's do the Dow, one of everybody's favorites, of course, now trading at 45. Well, actually no longer trading at 45,000. So let's watch that, see whether this is the beginning of something. It would be entirely in keeping with markets if, after all the tariff fears, the fact you've now got to deal with Japan and the EU, if we did see some short-term weakness in August, as ever, getting a bit of a reputation for a poor market. But yeah, breaking through on overnight those previous highs from February. So it's a good sign in one sense, good positive sign on the price momentum, but maybe just a little bit of exhaustion coming through, at least in the short term, ahead of what is, of course, a very busy week. There's not enough words to describe how busy this week in terms of earnings data and economic data, not just jolts, of course, payrolls and the Fed meeting on Wednesday. Thank you very much, everybody. Don't forget to like and subscribe, and we will see you again for charting next week. I like it.
Bill Blake! in the house. Good morning to you. How is it going over there with you in Hamble?
Good morning. I'm not entirely sure. I've been at my desk since the sun came up. I have looked out. It's definitely a world out there, but it's been a busy morning already.
It has been a busy morning and a busy overnight as well with, Intel, crypto, all sorts of things. I mean, it's just not been a dull moment so far in 2025.
Oh, I'm absolutely loving it. I mean, it's fantastic. I mean, Donald Trump is the gift that just keeps on giving. So much going on in the markets, and a lot of it driven by what he's done. But we're also in a period of enormous change as well. We've got changing geopolitics, we've got changing markets, and it's making it really, really interesting. We also have on the back of that a couple of really spectacular bubbles that threaten to unfold, and they're likely to shift the way that we invest. So, yeah, fantastic. If you're part of the market commentariat, as I am every morning when I'm writing my morning porridge, it's fantastic. When I then do my day job, which is in alternative assets, the private capital markets, suddenly it gets very, very difficult because the big investors are very concerned about what comes next and very concerned about liquidity risks and what are the real threats of the global economy and how might they impact the way that markets are trading.
The question, Blaney, everyone is asking is the comedy or the drama in the White House a problem for the markets? Is it? I mean, we've seen this happen time and time again.
Yeah, I don't, you know what? What's going on in Washington this week is just, it's interesting. It's potentially dangerous because Trump is clearly riled by the Epstein thing. It's causing him to make all kinds of distractive accusations. I mean, this thing about Barack Obama trying to mount a coup or Jerome Powell wanting to build himself a marble palace.
Which he's not going to be in for long, even if he was built.
It's crazy. This is all distractive noise, but it's clear that Trump is really riled by the whole Epstein thing. And perhaps he has good reason to be riled. The rumors are that he's been told his name features prominently. But come on, that's what we expected. We knew that. The problem is, though, that a riled and volatile Donald Trump could tip things messy very, very quickly. Now, I think the markets always expected this, so it's not the end of the world. You mustn't panic about it. But markets are sitting down and they're trying to figure out what does it mean in terms of the US stock market, which we all know is priced for above perfection. What does it mean for the US debt markets, especially if we see the Republicans split down MAGA and Republican things and they're unable to agree on budgets and debt reconciliation and such? And what does it really mean for the US economy? So far, let's give Trump the benefit of the doubt. The US economy has actually done much better and has been far less impacted than everyone thought it would be from the tariffs. We haven't seen the galloping inflation that we all assumed was going to happen. In many ways, it's actually worked. Now, that may just be because these things are delayed. But there is a real growing risk in the US economy, which is not related so much just to the tariff actions. It's where the US consumer is. And let's be brutal about it. The US consumer is tapped out. And for the economy to continue to grow and justify where we are in the markets, you can't have consumers who are being hit with rising consumer delinquencies on credit cards and auto loans. In fact, auto loan delinquencies, I think, are at the highest rates since the global financial crisis, the immediate aftermath of that. We've got student loans are now being collected against. That's money straight out of everyone's pockets. And we've just had this earnings season, which was fairly robust. And I couldn't believe the number of reports that were saying the same word. And that report was resilient. I mean, they were all saying, oh, the market is more resilient than we thought. Well, I think there's a consumer shock coming. Now then go one step along from that and ask yourself, what is it that's really been driving the markets the last couple of weeks particularly? And it was, Elliot just said it earlier. He said, it's FOMO, fear of missing out. All the institutional money has been trying to short the markets, thinking, this has gone too high, we are overpriced. But it's been kept up by retail money coming in on the basis of FOMO. And it's that kind of speculative trade that is making US markets look so overpriced at the moment.
Elliot
now,
also said it was at FOL.
Go.
Yeah, the fear of loss. Elliot also said, you know, other than FOMO, it's also fear of loss, right? So
yeah,
all
but
those
I think FOMO
fund
is
managers.
the most important, strongest force in financial gravity.
Pelican chiming in. Good morning to you, Mo. Asking you if you would use gearing for your fund if markets go south.
Would I use gearing? Well, actually, what am I? I am not going to give trade advice, and I shouldn't really talk about trades that I have on, but my favorite trade at the moment is my levered short on Tesla. Now, Angeline, you've known me for years and years, and I think as long as you've known me, I have been short Tesla. And you know what? It's never worked. I always get wiped out in the end because I know, because I'm a very highly intelligent market analyst, that Tesla is unsustainable. But the market doesn't know that, and so Tesla has bounced higher and higher for years. I think it's all finally coming to roost now. The numbers that we saw this week from Tesla confirmed, in my view, it's now nothing but a meme stock. That's all Tesla is. Now, that has massive implications for the rest of the so-called Magnificent Seven, M7 as I call them. But I think Tesla, you know, that's my levered trade at the moment, is a big short on Tesla.
Even if you've been calling this for as long as I've known you, since we were 4?
I'm not sure automobiles were actually invented when I was 4.
I'm trying to imply that we're very young here. Also, the other thing, Bill, is that, you know, Tesla, despite everything, it does have, of course, this big cult following, right? Let's not forget that. This big cult retail following that keeps...
That's the definition of a meme stock.
Yeah, keeps supporting it. And as long as that remains in play, you know, this is going to be one that is supported. We see, you know, buyers coming in at around 288. We see buyers, you know, still every time it kind of dips to that level, we see it come up again. And to be honest, those numbers recently were terrible, right? Outlook was terrible. And yet I wouldn't be too surprised if we see a bounce up again later on today.
And seriously, what is it going to bounce up? I mean, let's just think about what Musk said 2 evenings ago at the Q2 earnings. He said, I mean, I couldn't believe he giggled as he described a 12% decline in sales. I think the 7th successive quarterly decline in sales in California, the key market in the US for Tesla. He then talked about how he would roll out Tesla auto taxis in half of America by the end of the year. Hang on, that's entirely dependent on regulatory approval. And guess who hates Musk the most?
Right
who has
now.
His fingers on the regulatory pulse. That ain't going to happen. I think he mentioned something about 100,000 Optimus robots a month by the end of the decade. That ain't going to happen.
No, because I think the gamble was to get the revenues from the so-called robo-taxi to then drive that into the development of Optimus.
Now, there is a rumor, I'm not sure it's true or not, that there are only 10 auto taxis in Austin, and they're on a very small circuit, you know, where they're deemed safe to drive. And I am told that one of these robo-taxis has already been vandalized and is off the road. I won't tell you how it was vandalized, but apparently it's quite rude.
Boston Frank saying nothing is overpriced or underpriced. Prices are where they are through the interaction of buyers and sellers. Boston Frank, you sound like a technician yourself, because that is what technicians say, that it should all be reflected in the price. But my humble opinion is it should also move hand in hand, in tandem with fundamentals. And right now, the fundamentals, short term anyway, for Tesla, not looking great. Of course, Tesla's all about the longer term as well. Let's not forget that. Those that follow this stock closely know that it's all about, the outlook, space, logistics, and the rest. But back to trading. What's happening in the US right now. Yes, we're seeing the credit side of things not looking great. But Bill, don't you find that we've been in this place before? The US consumer seems to be ever resilient, right?
This is the word that I question, Angeline. The resilient, I think, is the wrong way to describe them. Look,
each time we think they're going to crack, they haven't cracked. We've been here before.
And they never will crack and completely collapse. But there is a deep significance to the way that the retail consumer consumes, and we're going to see that illustrated quite soon. Last year, in the election, Trump had his 25% of MAGA core who absolutely, they were going to vote for him no matter what. No matter what happens with the Epstein rumors, they will still vote for him in 18 months at the midterms. The difference is going to come from US consumers who switched to voting for Trump because they thought, the Democrats were just so bad. They bought the PR and they switched to buying Trump's. Now, they are not seeing their position materially improve. They have seen inflation is not lower. Interest rates remain high and are likely to remain so. They have seen their wages flatline. Nothing is getting better. These are the people who are going to look at the economy and say, yeah, Trump has done some things good. Yeah, he's delivered on some of his promises. But my personal situation is not any better. And that's when, in the midterms, in 18 months, you see the real significance of this decline in consumer confidence, that they will switch away from the vote that they lent Trump. And that brings the end of this era closer.
I disagree. I think Trump is, yes, I do, with everything that we've seen of Trump. He is the only person with enough firepower to even if he fails to bring through this growth, he has enough firepower to start a war. He has the ability to stimulate growth elsewhere and to create some other diversion. And the other key thing as well, Bill, is, when BBC just did a panorama and they went to all the Trump strongholds, and I think it was filmed in the last 8 weeks. Have a look, and you can find it on the system. They asked all these people whether they would still vote, given what they know now. Some of them very eloquent, by the way. They did a big sort of cross-breadth of, people that voted for him. And they said yes, even after what they know so far, they will still vote for him. And I think the key to this, and I've spoken to many Americans, including those that I have a vast network over there because I used to work there. The key to this is also FOMO. What they're seeing on their mobile phones, what they're seeing on Snapchat, Instagram, TikTok, whatever. Everything is alluding to, Trump is right, good times. No surprise that he has his own broadcasting system, right? We all know that. And the other thing, too, is that if you look at any metric, never mind the debt situation or whatever, Americans have had it good compared to 3-4 generations ago. I mean, even on a health basis, yes, they have an obesity problem, but on average, most Americans are living longer. The thing here I want to underline is that he has the firepower to change the narrative. And therefore, I think the midterms might be a surprise. You might find that there's even more supporters.
I think we're going to have to watch and see what happens here. Because this...
You sound like producer Phil.
I think this likely failure of Trumponomics and Maganomics, whatever you want to call it, to deliver on the kind of promises that Donald Trump made to the electorate, and especially to the swing voters and to his MAGA constituents. If that is not delivered over the next 18 months and they don't start to feel more prosperity and they continue to feel tapped out, which is the way they feel today, that's going to be the critical influence on the coming elections. So you and I will start putting money on this over the next 18 months. I am going to say that they're going to struggle. Now, the thing that may save Donald Trump perversely is the Democrats. Now, there's a great saying, I think it's been ascribed to, the ancient Chinese philosopher Sun Tzu, never interrupt your enemy when they're making a mistake. And there's a lot of people thought that's what the Democrats were doing, but it's not, is it? Because Trump is scoring successes, as you say, and he does control the narrative to a certain extent. I think the problem with the Democrats are they simply have not got used to the fact of being spanked at the election last year. Now, I think one of the great failings in the UK, and one of the reasons that the UK is in such an absolute mess today, is the fault of the Labour Party over the last 15 years, when they failed to provide an effective opposition to an absolutely terrible series of Conservative governments. Now, I fear that's what may happen in the US as well, that the Democrats are failing to provide the kind of pushback that keeps Americans aware of what it is they have in terms of a strong, free, democratic economy. And if they don't act soon, then, yeah, they will gift Donald Trump the power to maintain that narrative that you're talking about. So, as always, these things do come down to what the market believes, which is about the aspects of where numbers and results and earnings, but it also comes down to how consumers feel. And if they're not spending, that will have an impact on earnings, and they will be disappointed and will change their voting narrative again. So this is something we need to watch very carefully, I feel.
So I get asked very often, how do we trade this, Ange? How we invest in this environment? So the first thing is to shrink your position sizes, little and often, as they say. Also diversify your holdings. We talk a lot about that on the show, Rich and I. Make sure that you don't have all your eggs in one basket. I'm certainly using my stocks and shares ISA to diversify my pensions holding. Set stop loss orders religiously. I'm a stop loss girl here. Make sure that you have guaranteed stops on dates and times like August 1st, for example, or, in the precursor to the days before August 1st. Sometimes it's the weekend before August 1st when you start getting those tweets. Keep your cash on the side. Keep your cash ready to be deployed. That's what I'm doing ahead of August 1st. I've got some of my cash positions deployed in building a position in some select gold miners, but the rest of it, I'm waiting to see what happens in the coming weeks. And stay adaptable and unemotional. We talked about a lot of biases here. We've got SR talking about trading psychologies, and also we had Scotty Byrne here with us yesterday. He changed his candles, which I really liked. Bill, have you done this before? He changed his candles to yellow and blue because it's less emotive. I quite like that.
Yeah, I've never tried that.
I'm going to try that this weekend. The red and greens don't work so well for my astigmatism.
I tend to be less. I'm not a chartist, and I've always been somewhat dismissive of charts. Although when I started in the markets, the very first market I really got involved in using charts in was actually the Japanese stock market in the late 1980s, when we were going through this fantastic boom in Japanese equity warrants. And at that point, I was taught by a chap exactly how to use it. I was referred to things like Elliott theory, Elliott wave theory, and things like that. And so you pick in all the elements of that. But I've got to say, I've never actually thought about, I tend to be driven less by charts, but more in what I read in terms of what I think the sentiment of the market is. I mean, because the sentiment of the market is what you trade in. You invest based more on common sense. But certainly trading is much more a sentiment-driven thing, because that's how the market is going to vote. Because remember, that's all the market is, a massive voting machine. So you watch the sentiment. Now, you can get a good idea, especially when you've got big ups and downs on your candle charts. But I think it's a much better idea to listen. And what I see at the moment in the States is a market that is very much driven by retail FOMO sentiment. And when that switches into, oh, this might go wrong, it's already going to be too late for the people who are piling into the market now. Now, does that mean we have a massive crash in prospect? No, it means we've probably got something like a correction. But as soon as somebody like me says, oh, don't worry, there's a correction coming up, not a crash, that probably raises the probability of a crash.
Marcus Kane chiming in again saying, Bill, where do you actually see the fund flows?
The fund flows, the thing that's driving the US market just now is partly the institutions covering shorts, but mainly it's the retail flows that's keeping everything so high.
Also, Pelican chiming in saying, and save enough chip for the dip. Avocado. October choppy, then Christmas rally. Is that your kind of outlook, Bill? Do you think we're going to get choppy October and then a Christmas rally? The funny thing is, Christmas rallies recently have been kind of getting earlier. Have you noticed that, Bill? It's been like last year, off the top of my head, I think it started in November.
Yeah, October is always the unkindest month for markets. And I think by October, we're going to really see the effects on global trade of tariffs starting to kick in. Now, I don't think they're going to be as devastatingly inflation driving as was originally feared, but they're going to be significant, and they're likely to stop the Fed easing. And that means there's going to be even more pressure. I wrote about 2 weeks ago that I reckoned Jay Powell was toast, that he may even choose to go so as not to damage the credibility of the Fed any further by keeping this constant debate about independence versus non-independence going. So I think we may be seeing certainly a less rosy economic picture. We're also going to be seeing these consumer effects that I was talking about earlier. So come October, I think you're going to have a slightly depressed market. But who knows? Maybe by then there will be real trade resolution happening, and we'll see things starting to bounce higher on a more settled global trade world. So yeah, that might be quite a nice scenario. At the moment, my outlook is for, how would you put this? Enhanced economic concern through the next 3 months.
Here we are, there we have it. So you heard it here first from Bill Blaine, enhanced economic uncertainty or concern. Right, Bill, always a pleasure speaking to you. We have to wrap up and we're going to do the week ahead after this, so stay with us. But Bill, have a great time. It looks sunny, good for sailing this weekend.
It is indeed. It's the start of the famous Fast Night race on Saturday, and I've actually got my Fast Night t-shirt on from a couple of years ago. We'll see what happens.
I've got my Musto jacket on. Speak soon. Friday.
I've actually never done the show open before. This is exciting.
Amazing. We've got Issa with us this morning, and also tons of other guests. We've got Elliot joining us a bit later. We've got Chris Beecham as well. And look at the sunny view.
Oh, it's absolutely gorgeous.
Do you know what the weekend weather forecast is going to be?
Oh gosh, should I be nervous? It looks good at the moment, but wait, is it going to stay good or?
I think it's going to remain dry. And last time I checked, but we are an island.
That's true.
And so, you know, this could be an interesting weekend. I do know that farmers across the country are very happy that it has started raining. Good morning.
Finally, after months, right?
Yeah. If you guys haven't seen, just Google pictures of farms around the country when it was really hot, and you can. Some of them look like deserts.
They look like a savannah, right? Yeah, it's crazy.
It's insane. Right. Let's have a look. Issa's going to take us through the coming up. Right.
Yes. So we've got a busy day ahead. We've got some chat about overnight action. We're going to talk about the opening bell. Then Ronnie and Martin are going to take us through the week ahead. Normally that is us to do, but actually today we're handing over the baton to them. Number of the week is going to be you, Ange, and Chris. Let's see for the rest of the show. All sessions opening bell. Also Ange and Elliot. Expert Edge. We'll have Bill Blaine. That'll be exciting. And then Decoding Crypto with Ryan will be also super fun.
Yeah. And what is crazy fun as well is that thank you very much to those who have started putting questions.
Already in the chat. The chat is buzzing.
Great. It is buzzing. And also on Discord. Are you on the Discord?
I'm not yet. I actually need to get it set up. Yeah.
It's a great resource. All thanks to Maturin. Maturin, for those of you wanting to be on Discord, you have to get invited by Maturin, MATUO03. The question is whether there are two other Maturins already in the system. Can you imagine?
Yeah, I don't know, maybe. But like, thank you massively to the mods who help manage that kind of self-organizing channel. It's actually like...
Yeah, I think Friar Tuck is also one of the mods. And lots of people already sending questions into me because I'm getting in a special guest in September.
Oh, really? Cool. Like doing like an AMA.
Yeah. This is a personal AMA, for our community. Peter Hambro, you know Peter Hambro of Hambro?
Oh, yeah.
Yeah, he's going to come in.
Cool. That'd be super fun. Nice.
So pulling in those. Should we
have a look at some of their chats, because I think it covers at the start of some of the overnight action. We've definitely heard, I think, some people talking about the Powell discussion with Trump.
Absolutely. I'm going to show my screen in overnight action. So stay right there. We're going to go right to overnight action right now. Right, here we are. It is exactly as you said, really interesting, Powell and...
oh God, it's crazy.
I know.
They were both with the hard hats on the Federal Reserve building site. It was like absolutely wild. And then Trump was just grilling him.
Yeah. And the fact that, Powell's face just says everything.
Oh my God, it's awful, isn't it? I would, regardless of whether you think he's made the right decisions or not, that just felt like a miserable place to be, right? With basically your boss just shit-talking you in front of everyone.
Yeah. And also the thing is, this is reported on the BBC as well.
Yeah.
That, the kind of names that Trump's called him, this is according to the BBC, it's called Powell names like numbskull.
I mean, yeah.
Look at JP's,
This is when he hands him the... So there were two standout moments from this, and I think both of them contribute to some of the uncertainty that we're facing at the moment from a pure, macro monetary side. So the first moment is this moment you're just seeing here, where Trump hands him a letter, and it says, actually, the amount you spent on these building works is not $2.5 billion, it's like $3.1 billion.
Yeah.
And Powell looks really confused.
Yeah, he does.
He looks so confused, and he's like, do you have any evidence for that? And Trump produces this letter, and hands him this letter, and you can see Powell in real time read the letter and work out what's happened. Yeah. And basically what Trump's done is include a building in this new building works that had already been built 5 years ago. So that they can kind of inflate the amount that the Fed seems to be spending on building works. And the reason this is all the problem is because excess spending on building works is a plausible reason for Trump to get rid of Powell for cause. And that's the only way that Trump can get rid of him, because the Fed is independent, and so that he can't just end Powell's term or fire him.
Because he doesn't like his face or anything like that,
Or he wants them to lower rates.
Yeah. But he made it clear. This is the thing that I found, like he made it blatantly clear too, because at the end of it, he said something like, let's just get it finished, as in the works. And even more importantly, lower interest rates.
So that was the second stand-up moment. Is they were wrapping up the interview, and one of the journalists asked him, like, do you have any final comments, especially in the context of like how difficult the relationship has been. He said, yeah, let's wrap it up, and then he like slapped Powell on the back quite hard.
Oh, I didn't see that.
Yeah, and then said, and of course lower interest rates.
It's
crazy, right?
It's crazy. It's crazy town, crazy town. Trader friends, all of you. So we've been talking about, lots of people asking about why is he paying so much attention to this cause, and calling him numbskull and the works as well. And there is a section of community out there. Say I'm not one of them. Just saying that there is a section of community out there. Saying that he also wants to keep the spotlight on the Fed, on JP, because...
So you can blame him, right, if something goes wrong?
He can blame him, but also it's kind of like a smokescreen to get everyone's attention away from the Epstein
stuff.
And so pay attention to that space, because those who are close to the matter, who will not be named, unless they come here and talk to us about it.
Wait, do you have like some intel?
I'm just saying that look it up, because there are some people out there.
Like a genuine breaking news?
Well, it could be. It's not the first time that I've got things right here, and it is a real thing whereby he wants to bury it. Right? We've seen him saying to the populace, sorry, you've been misled, and all that kind of stuff. But if there was a black swan, many people think out there, for Trump anyway, it's this list, this file.
Yeah, and also he's trained all his fans to be conspiracy theorists.
Exactly.
And now there's an actual conspiracy.
Like,
suddenly their muscle memory's kicking in, and everyone's like, "Oh wait, no, we didn't mean for us."
Yeah. Not for us, for the Democrats, not for us.
Yeah, it's funny. I think the issue with the Trump Powell stuff is like, sure, I definitely think it's plausibly right that he's just doing it as a distraction. I think part of the other challenge is like the debt is so massive that they have to find a way to make the debt more affordable. And there's basically two ways you can do that. Well, three ways you can do that. You can just genuinely grow your GDP, and then your debt to GDP will come down.
Yeah.
Doesn't look like that's happening at a crazy fast rate. So that option is kind of off the table. Option number two is you inflate away the debt. Which
that's how governments usually
do it, but like we've just come out of a cost of living kind of crisis, and Trump basically campaigned on lowering the cost of living, so it doesn't really feel like he wants to do that. And then the third option is you just lower interest rates and like
hope that growth kicks in.
Exactly.
PDQ.
Yeah, or at least just take the interest burden down. So much of the government debt is still on the short end of the yield curve because they've just been kind of extending and pretending in the hope that rates would come down.
Let's show our viewers the where we are on the yields for the 10-year, the 30, and the 5-year.
I mean, look at that. That's crazy. So US 30-year yields are basically 5%.
Yeah.
That means if we are comfortable locking our money up for 30 years, we get 5% return. The equity index return is only averages like 7 to 9%. That's true. 30 years. 30 years is a long time, but still, it's kind of crazy, right?
It is kind of crazy. But also the fact that, despite this, we're seeing this almost like Groundhog Day for the markets. They just keep marching higher.
So that was the other thing I wanted to talk about. So, like, despite all of this uncertainty, we're just basically having a massive melt-up.
Yeah.
Where in the last week, we've had, like, meme stock mania from Open Door.
To be fair, that it did fizzle off quite quickly. Like a Krispy Kreme,
sure. But Open Door is still, like, if you pull up the Open Door stock price, it's still frothy, right? Like, and implied volatility is still extremely high. And so I think we've got some of the kind of meme mania, some of the energy of that still existing. We have big cap tech names that are just melting upwards, like constantly just like kind of marching upwards, despite in some cases not super strong earnings. Like, I think if you look at Tesla's down post earnings. I think it was down at its worst 8.5%, which is quite a big correction.
Yeah.
but it's not crazy given how bad the earnings were.
I know, it was so bad. Weren't they? But
so-
this really does move, did move the way I expected it. So I'm showing you the hourly chart here. Actually, 4 hours might be a better view. But you can see...
But yeah, look at that.
Yeah. You can see that it's just come back up, plateaued again.
just
And this is the
flat.
daily chart there, right?
There's just an amazing amount of resilience in some of these big cap names.
Yeah. And so this is the daily chart, trader friends. And I did say on the show that we are going to see a big march lower for Tesla, because I just thought, you know, it's got so many headwinds, right, against it. Robotaxi, this is its big gamble, in my humble opinion. It wants the revenues from robotaxis and from, you know, the EVs and everything to then grab that revenue stream to build Optimus. And then that will be its next, you know, cult revenue generator.
It does
right?
feel
Optimus,
though
Optimus.
like every time you have bad news with Tesla, they like magic up some new business model.
Exactly.
That is going to be there in 10 years' time and is going to be incredible. But like, we still haven't seen the last one from 10 years ago, which is the robo-taxis. They're not really generating any revenue.
No.
You're not seeing full self-driving. Like, autonomous isn't quite there yet.
Yeah.
And so it feels a bit early to then be declaring victory on the next revolution.
Yeah, but that's why this is like a cult.
Well, it's a tough time for them, right?
It is a tough time. Plus that magic thing that regulatory credits.
Yeah.
So for those of you that saw my short on this, I said, you know, regulatory credits also that magic sauce is coming away. And in the short term, I think it's, you know, still going to be trending sideways for Tesla. But as you can see, each and every time we get, you know, a bump lower, there are people
Goodbye.
who are buying it, right? And coming in on that stock. And I wouldn't be surprised if in this session we see it, you know, recover and move back up again.
Yeah. I mean, I wouldn't be surprised.
Yeah.
Can we pull up NatWest?
Yeah.
So someone in the chat was talking about NatWest. NatWest had their earnings. You can have a look. So NatWest has had like quite an interesting run over the last kind of couple of months. Like look at that march upwards. So I think a lot of the bank names are like quite interesting names in terms of like defensive assets. Like I think NatWest is obviously like a retail bank. It's quite a defensive holding. You can see that there's a slum sector rotation that's starting to happen. I mean, like, I'm not going to spoil too much of the week ahead, but next week you've got Barclays, you've got HSBC doing earnings. It will be interesting to see. We had JP Morgan also do their earnings, which were obviously very strong. So there's a question to me around how much some of these like banking names actually start to just outperform.
Yeah.
I think especially given a period of quite difficult earnings. Oh, cool.
I'm gonna whack this up, but I'm gonna just preview this because producer feels like we're gonna have to do a week ahead later, so don't bring this up just yet.
Yeah, but look how many
I
earnings.
know.
Next week is crazy.
It's gonna be rammed with.
Oh my god, like Visa, SoFi, PayPal, UPS,
I can't close this eyes.
That's
Trader friends,
crazy.
we're going to have Martin come on later on and talk a bit more about this. Producers feels like you're ruining my segments.
Yeah.
But
well, it's a big
NatWest-
macro week as well.
It is a huge macro week. And NatWest, one that I'll be watching because it did raise its full year income guidance. And then started its £750 million buyback as well. Yesterday I was talking.
Back a lot of shares,
We had a poll yesterday about people who thought buyback should be banned.
Oh, really? Why?
And those that thought, yes, it should be part of your investment.
That's interesting. There's a really, really great book called The Outsiders, which is all about 8 different CEOs who, all of them basically follow a largely similar playbook. One of them, in fact, is Warren Buffett. And all 8 of the CEOs really think about like their role as capital allocators. And like basically there's just a couple of buckets that they can kind of put money into. They can invest in their existing business, they can invest in M&A, or they can kind of return money to shareholders. And my view is buybacks when prices are high are a bit stupid, but especially when you've got a lot of like employees on equity-based comp schemes, they make sense. And when share prices are low and you have cash on hand, it feels eminently sensible to me to be buying back shares. And I think it's actually a really great way of returning like money back to shareholders in a way that's tax efficient. It just makes sense.
Yeah.
So I think I'm pro buybacks if done responsibly. It's just sometimes you see companies take out debt at the peak of their valuations to buy back a ton of shares, and I think that's less responsible.
Yeah, irresponsible. For those of you looking to invest according to buybacks, those of you that like buybacks, for example, Barclays obviously looking at ones. BAE Systems is still in the middle of its buybacks. I was asked.
Funny, it's like the parallel to like dividend kings.
Yeah.
Like, who are the buyback kings?
Yeah,
Buyback queens.
Yeah, I mean, a lot of the usual suspects, right? So that you're legal in general.
Yeah. Cash generating businesses.
Yeah. Other stock that I'm looking at before we kind of talk about the melt up, VW, the other one that.
Oh yeah.
Yeah, because they've got.
They've come off a really difficult few years.
Yeah. But Volkswagen and many of the car makers in Germany had a bounce because of the outcome of the Japan-US.
The tariffs, right?
Yeah.
Wow.
And so, Volkswagen, Porsche, and all the others moved high.
Do you not think that Europe is going to get the equal car tariffs?
Well, at the moment, we're seeing this bounce up, but you know how everyone's been talking about this 15%.
Yeah.
I think we're in the world now, Issa, where, Trump. We talked about this quite often too. He comes up with a crazy number and then dials it back. Saying 15% seems okay.
It's so reasonable, even though it's 15% higher. It's like a lot of money.
Yeah, exactly. And so, but for today, Volkswagen coming out saying it sees its operating profit 4 to 5%, which is low end of 5.5 to 6.5%. So be watching that. Right, Phil, we got the chart. Are we up to the guess the chart yet, or have we still got time? Great. So let's just go through some of the. I did some digging and some crunching of numbers.
Okay.
So, Rich is obviously very bearish. He's taken positions whereby he's like, "Come on."
He's like very bearish.
Yeah, he's like, "We're going to have." I mean, he thinks that we're going to have a 10 to 15% correction.
I won't lie, I was somewhat bullish until I saw the meme mania, and I was like, maybe this is a bit frothy for me.
So he's kind of thinking we'll have that correction. I kind of agree too, but not that large. I just think it's just then, buy the dip and it goes back up
just
again.
Just a bit of a V.
Yeah, a bit of a V. S&P still inching higher, even though indicators largely unchanged.
It's crazy. Just look at it.
Yeah.
It's just totally wild. Like I think.
It comes in a time when not a huge amount has changed, right?
No, nothing has changed.
Yeah.
If anything, all that's happened is we've got closer to the August 1st tariff deadline.
Yeah.
And not really heard that many trade deals.
No, exactly. The market breadth, as far as I'm concerned, looking poor. Number of stocks hitting new highs, trader friends, still below July 3rd's levels. We've got the Philadelphia Semiconductor Index rising, but less than the NASDAQ. So its ratio as well is falling.
Well, I mean, pull up NVIDIA. Like NVIDIA also just looks like a totally crazy chart. It's now more than $4 trillion.
And I love how it did that quietly as well.
I know, right? It was like no news story. It was like suddenly just it crept up above that threshold. And I think it is really worth thinking about if you were to think maybe 3 years ago, is there a world where you would imagine NVIDIA would be a $4 trillion company? I think it's just mind-blowing. I think it was always quite a strong player in the space, but it was never this enormous a lead, right?
Yeah.
But look at that chart. That's a crazy chart.
I know.
Look how many green candles that is.
It's just so strong.
Yeah.
I mean, the momentum. We always say here,
it's almost like a safe haven asset, right?
Yeah.
It's just like I don't necessarily feel confident about the world, so instead of investing in gold, I'm going to invest in like silicon chips via NVIDIA.
Yeah, and there are some data points out there that say that there's still a shortfall of chips in the next 7 to 10 years. So depending on which way you think this will go.
Yeah. I think one thing worth just keeping an eye out on is if you look at the bottom of that chart, you could see volumes, and like we are in the summer period, and so you can see how low some of those volumes are. And so whilst this is obviously an extraordinarily strong performance, it is a strong performance of quite a low base of volumes in terms of trading.
Yeah. Rich on the show said he didn't think that Nvidia would get to 4.5 trillion anytime soon.
Rich is really bearish.
Yeah, he is. In the next few years or next year or so. So I used AI.
Okay.
And I crunched numbers using.
Is this to predict when you think it'll get there?
Yeah. I love a chart. You know I love a chart.
Yeah.
And so I trained it to wrap together all of the analyst projections in the last, so year to date.
Yep.
And also map out NVIDIA's rise in terms of its market cap to give me a bit of projection. And I'm going to whack it up for you, trader friends. This is totally unique. This is an ANG chart that you only get here.
So you think they will get to 4.5 by next year?
Well, according to this chart, if all the analysts in the world from year to date, from beginning of January,
you should do a bet with Rich. You should get him to buy you like a.
Yeah, I'm about to lose money to you already.
Chip. Oh my God, we should check in. We should check in.
I lose money to you already, but it's okay because producer Phil has lost a bet to me, so then I will use that to
all
fund
the same.
your.
It's all the same money.
Fund your Nike shoes, right? We have a poll. Let's have a look. Yeah. So, are you generally bearish or bullish on the market? Do put in your comments here. Have we got a duration?
As they say, only time will tell. Don't do it, cowards. Don't click the button.
Don't click that one. It's Phil's favorite line. Fire top, art of the deal. Absolutely. Go in with something that's so horrific and then come out with something you actually want. Boise, Friday sell-off at the moment. Profit taking, that's a question. Last 3 Fridays were red days. So that is a good observation as well.
Yeah, I think people sometimes feel a bit nervous going into the weekend because you don't know what news there's going to be and you can't really trade. So.
Yeah.
These are India, England, or neutral on the cricket. That is a tough question. For people who don't know, I was born in India and lived there for about a year. And then I lived in Turkey and then Switzerland. And I came to the UK when I was about 9 or 10. I am an England fan, controversially, for the cricket. But I know
controversial.
Well, but all my direct family are all England fans. But if I was to talk to any of my family in India, they would treat me like I'm some sort of outcast.
Scum.
So I am. Yeah, exactly. I'm an England fan. It helps that IG, of course, sponsors the cricket. But yeah, no, England for me.
I was hoping to catch the women's India versus England on Saturday, but it was completely rained off. And
did you catch the women's Euros though?
No, unfortunately.
That was crazy. It was one of the craziest games I've seen. It was like proper like a movie. It was the England team equalised in the 6th added minute of the final whistle. Basically, it was totally nuts. So they're going to the final, which would be nice.
Nice. Nikhil Shah saying Friday squeezes. Shorts don't want to hold short over the weekend. Yep. And also it's very tricky with, if any tweets come out over the weekend and you can't move very quickly. As quickly as this chart that you're going to guess right now, because it is Guess the chart. Is it UK or EU? It's a European one this time, people. Right, let's do it. Hey, trader friends. And the winner is, let's have a look at the chart first. There we go. Let's put it up. It is Volkswagen.
Oh, it is Volkswagen. I'm so bad at this.
Boise and Jugger. The only thing is, Boise said maybe.
Oh,
Ooh.
Should we reward low conviction players? But still, wow, I'm amazed they got that.
Jugger.
Look at the highs of that in 2023.
I know.
That's crazy.
I know, right? But also, I kind of it has slid because of the
the tariffs.
And also the 2023 is it at the end there? My eyesight's not great.
Yeah.
So it's probably the tariffs and.
It's funny though, if you look at the, I'm not a chart reader at all, but if you look at the big bit, it looks exactly like a bigger version of the small bit recently.
It's like like one's under the microscope. And the other one's
exactly.
enlarged next to it. Really nice chart though, I have to say. Clearly a downward trend there as it tries to tick up at the very end there. Jugger saying David was right. I was going to think, oh my goodness, get you guys in a room and arm wrestle it out. 3 even. Neil! I didn't see Neil's answer. Amazing. So Neil is away from the numbers. We met. You were there at the event.
I met Neil. Yeah. Wait, oh my God, we should keep an eye on the clock.
We should keep an eye on the clock. How many seconds?
Like less than 20 seconds away.
Less than 20 seconds. So just a reminder, trader friends, of where we sit at the moment. Obviously, we had those big numbers out from Intel overnight. Which mind-boggling.
We're also cutting 15% of their headcount.
3, 2, 1, go! And we are off, trader friends. Let's have a look, zooming in so that Issa can drive us through the early picture there.
So we're seeing US Tech 100 broadly flat on the day, maybe after those Intel earnings. Germany also kind of a little bit down, but broadly flat. Where have we got big movers? You can see the Hong Kong stock exchanges is down over 1%. That's quite a big move. Where else? We've got
Nikkei stabilizing. I mean, it's looking like a really
it's quite a stable day. It looks like.
Given a Friday, but also
Although look at the EU volatility index. You've seen a bit of like the EU kind of VIX have a little bit of a spike. That kind of probably comes ahead of like next week has Euro GDP and some of the CPI data. That's kind of interesting.
Yeah, it's at the 18 handle right now as we
still very low.
Let's have a look at the individual movers then. Here we are, FTSE, and let's look at the gainers first. Here we are.
Wow, so there's NatWest. We had just spoken about NatWest at the start of the show. They had really solid earnings. Like they're up over 1%. We've Intertech. Who else do we have? We have Lloyds. So we have quite a few of the banking names, actually. RELX is the exchange.
We've seen a real shift, movement of risk on back into like banks.
Financial services in general, right? And you can see a couple of fintechs, actually.
Yeah, so just a quick reminder, we had NatWest raising its full year income guidance and starting its share buyback as well. Also crossing over to the losers list there, London Stock Exchange Group.
Wow.
Down 1.2%. Our CEO, Brianka Corin, actually was at the LSE earlier this week recording.
Yes, because we had our earnings announcement this week.
Also, we've got BT Group down almost 1% there.
Wow, look, WPP is down. Have you ever seen the WPP chart for like five years? I've never seen a chart that I find more long-term depressing. So you zoom out as far as you can, basically.
Is it more depressing than Aston Martin?
I mean, if you go, just look.
This is the monthly chart.
Yeah, if you go from like 2018.
Yeah, here we are.
Just look at that. Oof. This is during an era where advertising has basically just all shifted online, and the degree to which you're willing to pay for like proper high-end creative is just on the decline. But look at that, it's crazy.
Can I just say that I'm not sorry because my father's company, the company he worked for, was
acquired,
consumed.
Yeah,
by
WPP is.
WPP.
They are famous for doing quite aggressive acquisitions.
And they didn't understand the model in Southeast Asia at all, and it was absolutely. Nightmare. Right, let's go over to Europe then. Let's have a look at Germany 40 first. Jugger, this one's for you.
Yeah, let's see some of the DAX names.
Right, let's
They're mostly red on the day.
Rheinmetall up there, RSAX.
Total as well.
Yeah, and then let's have a look at the losers list. Volkswagen.
Oh yeah, that was the chart we just seen. Adidas.
Yeah. Yeah, also Volkswagen, you know, don't forget we had Volkswagen earlier on, you know, saying that its operating outlook, ROS, 4% to 5%, that was at the lower end, right?
Yeah,
so that's putting pressure.
So I imagine for a lot of these car names, this is just a softening after a bit of a spike yesterday.
Yeah.
But like SAP is on the down list. SAP is one of the biggest tech names we have in Europe. Definitely the biggest tech name that Germany has in their index.
Also, let's have a look over in France. Here we are. You were trying to guess some of the luxury names earlier.
There's Total as well on the French list. Carrefour is up 4.7%. I imagine they must have reported earnings or something to get a move that big.
Let's see. Carrefour. We are. Trying to get that. There we are. Adding that to the workspace. Yep, it had first half results. Let's have a look. And also, Carrefour is one of those that was, Q2 sales growth of 4.4% like for like, and said it was in talks. That's right. That was what I was thinking of. It was
spinning off a business unit, right?
Yeah, and sell. So I think it wanted to sell its New Princess Group to try and use that cash to then fold into its smaller Carrefour, I guess like their metros.
Express, right?
Yes.
Yeah.
So many.
I can't remember what they call them, if they're like minis or like, like that. Yeah.
So that is the new model, which I find fascinating.
Well, it's very similar to the model in the UK, I guess, right? Because you've got like Tesco and Sainsbury's all doing these tiny like Tesco Express.
Yeah.
Sainsbury's local.
We're surrounded by Sainsbury's Expresses, and you can't get away from it. Right, we got shares in Italy's New Princess also failing to start after deal to buy Carrefour Italia, seen 16.8 up 16.8%. So there you have it. Just letting you know, I've got someone in my ear. I think it's Martin, producer Phil. Martin is speaking quite loudly in my ear.
Oh, maybe he's coming on for the next segment.
Yes, he is, which is why I'm kind of like trying to not hear him. Okay, so we've got those up there. Dassault System also up more than 1%.
Oh yeah, wow.
And Eurofund is up 2/3%. Thales, interestingly, up 1/4%.
Look at some of the losers. Look at Airbus. Wow. Right at the bottom of that list.
Let's see if there are any other movies.
Michelin, the tire company, who I think missed on earnings, they're down over 3%. Wow.
Yeah. Another one that's moving that Andrew McKelvey made a killing on yesterday is Wizz Air.
Oh yeah.
Because it's now bouncing after yesterday's fall. So I hope
again had quite a difficult run prior to this.
Yeah. So
wow,
that's the
look at that.
5-minute chart there. Barclays upgrading the stock to overweight.
Yeah.
Another one that Richie Rich would like. Angie's algo is now waking up, which is fantastic. Puma is down more than 17%.
Wow.
Trader friends. So if you're trading the luxury space there, this is one.
That's also a crazy.
Seeing a lot of pain. Andrew McKelvey, morning to you. Wrong move, down 3.5%. Thank you for that. We started calling it wrong move because I had a position when I was thinking it was going to get bought, right?
Yeah.
Wardy did as well. It's like, why is this not happening? Why?
I think the whole right move saga feels like a classic example of just like they've just managed expectations so poorly as part of the potential acquisition.
Yeah.
But yeah, I mean, if you zoom further out, Rightmove is one of those companies that I think it's just, I don't really understand the business model particularly. I don't know how it's profitable. Well, I imagine it's not, but look at that. Wow.
Yeah. This is the monthly chart there.
And that's the moment it was announced that it was. That's a clip edge if I've ever seen one.
Yeah, that was quite painful. I got stopped out, but it was still wrong move. Wrong move.
Wrong move.
Yeah.
Did you get stopped out?
I got stopped out.
In like near a level you wanted, or it was way below? It just went through blew past your stop.
No, I did a guaranteed.
Oh, nice.
Yeah,
nice.
which is good. But Wardy and I were commiserating.
Well, but imagine if you didn't do a guarantee. Yeah.
Yeah, so trader friends, for those where I say bring out your gloves, make sure you have a guaranteed stop. Right, we've got the poll results out now.
Yeah, let's see. Are
quick
people
look.
bullish or bearish? 18% say only time will tell. I blame producer Phil. This is this is a negative influence on our audience. But 47% bullish, more bullish than bearish.
Yeah. Which you know, that's what makes a market, right? So
yeah, I mean, like the market it does have positive drift, so
yeah.
I think if you don't know what the right answer is, it probably is right to just be bullish. Like, unfortunately, yeah.
There is a saying that you know, markets, and Bill, this is one of Bill Blaine's sayings, that you know, markets tend to be more optimistic than you think.
Yeah.
Most of the time.
Well, the other one that I really like is bears feel really smart and bulls make loads of money.
Yeah, I mean, if you were a bear before April until now, you'd be crying in your cave, right?
Yeah, I was a bear in Feb, which thankfully did pay off. But like, I think after that initial correction, I think it's just been just straight up, basically.
Yeah. Right, so we have been so busy going through all the movers that we didn't manage to go through some of the big change in broker ratings. So we mentioned the Wizz Air one already, Andrew McKilvey, but LVMH also
an upgrade.
Jefferies cutting its target price.
Yeah, I was going to say I'd be really surprised if it was an upgrade.
Yeah, to are you bearish LVMH?
Oof, I think the luxury sector is going through not a great time at the moment. I think. Yeah, I don't know. I feel like there's also within luxury, there's like luxury, and then there's not quite as luxury.
Yeah.
And LVMH obviously like has a kind of mid to lower like position in that relative to an Hermes or a name like that.
Yeah. Any dip on Hermes, I'm interested.
Oh really? Because you're just so confident the demand will be there.
It will come back. It will come back.
Yeah. LVMH is a tougher business though, and yeah, you can see that it was actually its peaks in Feb, and kind of has just been declining since then. They get hit quite badly by the tariffs.
They do.
Actually. Yeah.
They do, because the thing is, like, you know, LVMH, unless you're buying Vuitton. Then it's pretty hard. L3 Harris Technologies, for those of you that cover the defense space here, TD Cowen raising its target price to $290 from 280. We also have SAP Barclays raising its target price. SAP, a really interesting one because it just had earnings in it. Didn't it?
It was slightly disappointing actually.
It was disappointing, but you know, it is really struggling in the space of the trade uncertainty, and also don't forget it sells kick-ass business software, right? And when times are uncertain, the clients of this sort of software
don't want to
move, or they sit on a deal, or they put their hands in their pockets and say, let's wait till the clouds disappear.
I also think the reality is that it's just getting to be a more competitive space, especially because it's much easier to ship stuff with AI now, that like actually a lot of SAP's previous advantage is a bit harder for it to kind of work.
Yeah. Totally. Right, we have to go to break, but one more. Palantir, Piper Sandler initiating coverage with an overweight rating. A bit late to the game, but you know, hey, target price 170.
Well, the only final one I'd probably like to call out is, have you seen the American Eagle price?
Oh, yeah.
Since the Sydney Sweeney campaign.
I know, and then they all laughed at me because I didn't know who
10%.
Sydney Sweeney was.
Really?
That's
That's crazy. Different generations, Ange.
I don't know who Sydney Sweeney is.
She's iconic it girl. It'd been in like all the big movies recently.
No idea.
No idea.
No idea.
You look blank.
I'm totally no idea. I think some people have sent me pictures and things.
Well, she moved their share price 10%. You should learn.
Tell me about jets, people. So we don't know. All right, on that note, we're going to go to our next segment. I think Martin is waiting in the wings. Is that right? The week ahead. So stay with us.
Okay, guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat. Cash returns, come on. Oi! Well, you're not going to get better than cash returns.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Bring me the next shiny new thing. Bring me the next shiny new thing.
We're watching a crisis unfold in the UK and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings-first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs, from scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
All right, hello, and welcome everyone to, I think this has got to be one of the first editions of the week ahead. My name is Ronnie. Sorry guys. My name is Ronnie and I work at the PCM desk, and I'm joined today by my brilliant colleague, Martin Harris. Do you want to introduce yourself?
I'm the brilliant colleague, Martin Harris. I work as a portfolio manager at IG, and we work alongside the PCM team, the likes of Ronnie and the other superstars in that team. And we've been invited today to give you some news about the week ahead.
Exactly. And as you guys know, us on the PCM desk, we're very good at sort of talking and telling a story, but Martin actually knows what he's talking about. So that's why we structured today's program, where I will question Martin about what's coming up in the week ahead, and hopefully you'll get some insights to how to adapt your trading for that. So, Martin, do we want to get started with the equities? Producer Phil has been kind enough to get the chart up. which sort of equities are you looking at, and which one of them are sort of popping out for you the most, and which one do you think will move the markets the most?
All right. So, I mean, we've had an action-packed week so far of earnings releases. It's not stopping. Next week, almost accelerating. We'll just go through line by line, taking a look at Tuesday. So big one starting off is going to be Boeing. It's really one that I want to watch. Boeing at the moment, I'm just going to pull up one or two notes I do have. Boeing at the moment, what we're tracking is the number of aircraft they're able to produce per month. So Boeing currently are producing in the low 30s each month. They've got a huge backlog of orders that they need to get through.
Low 30s?
Low 30s. They're producing low. So let's say they're producing 30 aircraft every month. They need to, they've indicated that they want to reach a production sort of capacity or a monthly run rate of 38 to 39 aircraft. So that's going to be the big thing that we're looking at, is how many aircraft have they managed to get to since they last reported. And they've got a huge backlog to get through. The market actually wants them to be at about 45 aircraft a month. There's also going to be news around, they've won the F-47 program, so they've secured contracts for creating the 6th generation fighter for the United States, and also need to see what's happening with regards to tariffs from China and other import destinations where they get certain parts from. So that's something that we're looking at for Boeing, but in general, it's really just about how they're doing with production. The other big companies for the day, I mean, we'll just go through that list. I've really just isolated the big ones. PayPal, Procter & Gamble, Spotify, which is going to be a great one for, in the tech space, trying to see how
the consumers are doing. As well.
Exactly. Well. I mean, that is probably the 10% of the GDP of Sweden at this point. United Health Group will be an interesting one because healthcare in general has been a laggard. If we look at like sort of the cyclicals that are, so I've mentioned this before, is that, typically the defensive stocks are not stocks that are in military defense, but defensive stocks, healthcare, consumer staples, and what used to be a defensive, which was property. Those have all been laggards in the last quarter, and we've seen all the cyclicals, the semiconductors, defense stocks, banks. They've all been really well supported. And that's really been about the changes that we're seeing with the current fiscal situation in the United States and how the administration support these stocks. So pharmaceuticals and healthcare have done poorly. We want to see what's happening in their last quarter because they're starting to enter almost a positive valuation space where you might see some value buyers coming through. Booking.com going to have a great sort of snapshot of like kind of the overall tourism market.
Yeah, it show a sort of greater overview of the industry in itself, right?
Exactly.
Looking at bookings, seeing number of bookings and across, because they're a global player as well, so it'll give you total insight. What sort of data are you looking for when you look at a company like Booking reporting?
So we're looking at same month sales. So what we want to do is compare period on period because obviously it depends on which part of the year people are traveling in, but you want to see capacity for hotels, and you want to see price that they, the average sort of ticketing price that they're getting. Booking, fairly, it's going to be a difficult market for them. So they were, one of the big winners of like early adoption of Google as a search function. Now that search is moving towards AI, how are Booking handling that? So that's going to be a key component for them to challenge going forward, is actually instead of you using just Google searching holidays wherever, you're getting your AI agents to find bookings for you, and that's going to and booking directly with the hotel rather than going through a third party like Booking.com. So that's going to that wouldn't have taken over too much yet, but we want to see what they've got to say about that. Marathon Digital, they've had a bit of a run because they're heavily involved in Bitcoin blockchain. They also supply cooling systems for Bitcoin farms, things like that.
Yeah, and they've had a Bitcoin and crypto market in general has been on a mega bull run lately.
Exactly.
So that's sort of one of those holdings that come in and sort of gets lifted by the positive crypto price. So that's a company like that is something you can look at our new crypto index. I'm not sure if you've seen it or anyone at home. We now have a crypto index on IG, which is not just an index of crypto, not just a basket of cryptos, but it's actually sort of adjacent companies such as Mara Holding that you'll be able to get exposure to through one investment. So,
and then
sorry, please continue. That's it.
Sorry, I just realized there's so many things. I'll try to fly through these and not add too much. We don't have a lot of time. Last one I'll really comment on is Starbucks. So they obviously had the new CEO, Brian Nichols, starting, and they implemented a new sort of